Happy morning, one and all. So, we'll be starting today with the new topic for revision, that is Consolidated Financial Statement backed by Accounting Standard 21. Sir, what does Consolidated Financial Statement mean? Adding two or more company ka financial statements. So, consolidation simply means adding two or more company ka financial statements. Any random company ka financial statements can you add? Like ArivuPro ka financial statements with Reliance ka financial statement. Is it possible to add? No. If you want to prepare consolidated financial statements, there has to be one key aspect called control. Only one company controls the other company. Then only we need to prepare consolidated financial statement. Otherwise, if this control is not there, consolidated financial statement is not necessary. When I'm talking about consolidated financial statement here, I'm talking about AS 21, which talks only about parent and subsidiary ka consolidation or holding and subsidiary ka consolidation. We are not talking about associates or joint venture. We'll cover that later after this. Okay, we have a separate standard for that. So for you to consolidate holding and subsidiary company, one company should have a control over the other company. So let's say H Limited has 90% shares in S Limited. So can we say H Limited has control over S Limited? Yes. Sir, when do you get control? If one company owns more than 50% shares in another company, then we say the person or the company holding shares, we call it as holding company. Another company, we call it as subsidiary company. So consolidated financial statement is simply taking H ka financial statement and adding up with S ka financial statements. So it is not plainly adding up. Okay, so there are certain pointers. It's not just take two company ka financial statements and randomly add up. There has to be certain other factors we need to keep in mind. So you remember the working note we used to prepare. So all these are practical problems or problem specific pointers I've written over here. But before that, first we'll summarize. You remember 7 working notes we need to prepare in consolidated financial statement. First working note, normally we used to prepare to get the shareholding percentage. How much shares holding company has in subsidiary company. Okay. So in this particular example, if holding company has 90% shares in S Limited, means there are somebody else who owns 10%. That somebody else only we call it as minority interest. Okay. All right. So this is one. So first working note in consolidated financial statement problems is to know how much shares is held by holding company and how much shares are held by minority interest. That's the reason working note number 1. Second step is to prepare the general reserve of the subsidiary company. Okay, if at all they give you general reserve of subsidiary company, prepare this working note. Next working note we used to prepare was P&L account of subsidiary company. Then fourth one is analysis of reserves and surplus of subsidiary company. So all the subsidiary company ka reserves and surplus. Sir, where do you show reserves and surplus under in balance sheet? Under shareholders funds. So all the reserves and surplus of subsidiary company should be allocated among the shareholders. Who are the shareholders of subsidiary company? Holding company and minority interest. So that allocation of reserves and surplus happens in working note number 4, and in consolidated balance sheet wala problems, working note number 4 is the most important one because it will have the maximum number of adjustments. Okay. So in working note number 4, analysis of profits of subsidiary company. First, all the reserves and surplus of subsidiary company will be distributed among holding company and minority interest. But before we split, the reserve has to be further segregated into what? Pre-acquisition profits and post-acquisition profits. Pre-acquisition reserves and surplus and post-acquisition reserves and surplus. Pre-acquisition means what? Before holding company became shareholder, what and all reserves and surplus subsidiary company had. Before holding company became shareholder, what and all reserves and surplus subsidiary company already had, that we call it as pre-acquisition reserves and surplus. After holding company became shareholder, what and all reserves and surplus came, that we call it as post-acquisition reserves and surplus. So distribute reserves and surplus into pre and post, and this pre and post will be distributed among holding and minority interest in their respective shareholding ratio. Okay, that's one. All right. Next, working note number 5 is the minority interest. Like here in this particular example, how much does minority interest own? 10%. Sir, minority interest is a shareholder. What and all shareholder or what and all will you show on the shareholders funds? Visualize balance sheet. What and all you will show on the shareholders funds? Share capital and reserves and surplus. Minority interest is also a shareholder. So what and all minority interest shareholders will ask for? Their share of capital, their share of reserves and surplus. Now reserves and surplus of subsidiary company is already split into 2 parts. What are those 2 parts? Pre-acquisition profit and post-acquisition profit. So when you prepare minority interest ka working note, 3 components you need to bring it in. One is minority ka interest ka their share of share capital, their share of pre-acquisition profit, and their share of post-acquisition profit. Okay. Then we prepare working note number 6 called goodwill or capital reserve. Goodwill, instead of goodwill, here we call it as cost of control. That's another terminology. Okay. So how do you get goodwill or cost of control? First I'll run through, then we'll apply all this in one question. Before I apply, I want to give you the step ka workaround. Okay. So how do we get goodwill, sir? First, take the cost of investment. If there is any pre-acquisition profits or pre-acquisition dividend, reduce it. Then reduce it from, compare it with what, sir? Total share capital or holding company ka share capital? Holding company ka their share of share capital in subsidiary company, you compare. Okay. So if you get a positive number, goodwill, negative number, we call it as capital reserve. That's why we used to get goodwill or capital reserve in this particular working note. Yes. Last working note is to get consolidated reserves and surplus. This consolidated reserves and surplus will be directly shown in consolidated balance sheet. So what do you do over here? First, take holding company ka all the reserves and surplus. To that you add what, sir? If there is any post-acquisition profit of subsidiary company, you add. If there is any stock reserve adjustment means what, sir, here? So when will that come? If holding company has sold goods to subsidiary company. If holding company has sold goods to subsidiary company, do you think sales would have happened at cost price or sales would have happened at selling price? Sales would have happened at selling price. That means holding company would have made some profit. That profit is included in whose stock now? Subsidiary ka stock. So holding company made profit. Now, are you treating holding company and subsidiary company as two different companies or one company? One company. So that means this is realized profit or unrealized profit. As long as there are two separate companies, one company can make the profit from other company. But for consolidated financial statement, you're treating them as one. So hence, if you have any unrealized profit like this, that we call it a stock reserve, needs to be eliminated. Because holding company made the sales to subsidiary company here. So who made this profit? Holding company. So holding company ka P&L balance is already increased. Hence, we need to eliminate it. Okay. Then if you have any pre-acquisition dividend, reduce it. So this is just the format, okay, that we used to do. All right. We'll spend a little more time about all this in the problems once again. But this is just an overview I wanted to give you. Okay. Fair enough. All right. Now, can we dive into one question before I read out through all these adjustments? All these are problem specific pointers I've written there. But right now, if we understand it, it will be glimpse and pieces. So what we will do is first we'll take one full-fledged question of consolidation, solve it fully. Then we'll come back to these pointers and see whether these pointers are making sense to us. Can we do that now? Everybody? Yes. Online also, keep typing so that I know that you have revised or I know that you also remember. Okay, whatever. Whenever I ask a question, you also type. It's fine. So that I'll also get the confidence that you remember things. Okay, so let's take up question number 10. This is quite popular question, has come a few times in the examination. Okay. Great. All of you found the question. It's there in the study material. Even if you don't find, not a problem. You can look at the screen. From the following balance sheet of H Limited and its subsidiary S Limited drawn up on 31st March 20X1. So that means year is ending on 31st March 20X1. So what is the current year? 1st April 20X0 to 31st March 20X1. Correct? All right. Prepare consolidated balance sheet with respect to the following information. Reserves and P&L account of S Limited. Sir, S Limited is holding company or subsidiary company? Subsidiary company ka reserve balance and P&L balance they've given. At what value? Reserve balance is 25, P&L balance is 15,000 respectively on the date of acquisition. Who acquired shares here, sir? Holding company acquired shares in subsidiary company. When holding company acquired shares in subsidiary company already had this reserve. Already they had this reserve. So any reserves and surplus existing on the date of control, on the day holding company got control over subsidiary company, if subsidiary company already had any reserves and surplus, means such reserves and surplus we call it as post-acquisition profit or pre-acquisition profit. Pre-acquisition profit. So that means these two are pre-acquisition profit. Correct? Okay. And what is the date of control, sir? 1st April 20X0. On the first day of the current year only, holding company has got the control over subsidiary company. So that means these two are general reserve and P&L ka opening balance also, can I say? So, okay. So they've given GR ka and P&L account ka opening balance. All right. Machinery whose book value is 1 lakh. Furniture whose book value is 20,000 were revalued at 150 and 1,15,000 respectively. Sir, what is the book value of machinery? 1 lakh. But what is the revalued amount? 1,50,000. So loss or gain? Gain. Now you think holding company has to get control over subsidiary company, means will they get this control at free of cost or they have to pay money? They have to pay money. Correct? No. How will they decide the money ka value? How much to pay? How will it be decided? Based on net assets of subsidiary company, because net asset means net worth of the company. Now you tell me, If you want to buy, if you want to get some control over another company, will you value that company ka net assets at book value or market value? Obviously, whatever is the market value, based on that only you will decide the price. So now you tell me, for consolidation purpose, should I take book value or should I take market value? So you should take market value, because the cost of the investment is on book value terms or market value terms. Market value terms. So I need here what, sir? I need book value or I need market value? Market value. Check. What is the book value of machinery? 1 lakh. But market value is 1,50,000. That means there is a revaluation gain. On what? Machinery. Worth how much? 50,000. 150 minus 1 lakh, which is 50,000. Agreed on? Fine. So this 50,000 should we consider for consolidated financial statement? Yes. Has subsidiary company considered? No. Sir, is it a mistake? No. Subsidiary company has a choice. We have already studied AS10. Subsidiary company has a choice either to follow cost model or revaluation model. They can either show their assets at book value or they can show it at market value. Yes. So subsidiary company is showing it at book value. Have they done any mistake? No. That is their choice. That's what they have done. But all this revaluation gain, revaluation loss is what adjustment? Consolidation adjustment. It will only come in consolidated financial statement. Subsidiary company has not done any mistake, but still we need to consider this revaluation adjustment in CFS. CFS here means consolidated financial statement. Agreed on? Okay. Similarly, furniture ka, what is the book value? 20,000. But revalued amount is only 15,000. So it's a revaluation gain or revaluation loss. It's a revaluation loss. So how much loss? 5,000. So this revaluation gain also we need to consider. This revaluation loss also we need to consider. For what purpose? CFS purpose. Okay. Alright. On 1st April 20x4, for the purpose of fixing the price of its shares. The rate of depreciation computed on the basis of useful life is machinery is 10%, furniture is 15%. Now, sir, subsidiary company would have depreciated their asset, like let's say machinery. They would have depreciated the machinery at 1 lakh rupees, because that is the value of their books on the first day. That means they have calculated depreciation on 1 lakh. But for consolidated financial statement, are we taking machinery ka value as 1 lakh or 1,50,000? We are taking 1,50,000. So subsidiary company has calculated depreciation on 1 lakh. Any mistake or they have done correctly? They have done correctly. But for consolidated financial statement, we have to consider 1,50,000. So that means on how much value of asset subsidiary has not depreciated. On 50,000 of assets, subsidiary company has not calculated depreciation. Any error or consolidation adjustment? Consolidation adjustment. So that means we need to calculate depreciation on this additional 50,000 also. 50,000 into 10% is how much? 5,000. So on this machinery, you will get some extra depreciation of 5,000. Correct, people? Okay. Similarly, what is furniture ka book value? 20,000. So all this book value as on which date? It's as on 1st April 20x0. And year is ending on 31st March 20x1. So subsidiary company would have depreciated this furniture by keeping what as the value? 20,000 as value. They have depreciated on 20,000. But are we considering book value for consolidation or revalued amount? Revalued. What is the revalued amount of furniture? 15,000. Sir, subsidiary is depreciated on 20, but we need to calculate depreciation only on 15. I mean, subsidiary company has calculated less depreciation or more depreciation? More depreciation. And how much value? 5,000. How much is the furniture ka rate, depreciation rate? 15%. That means what is the 750? Or correct, no? So 750 is the extra depreciation which subsidiary company has accounted. Fair enough, people? That means this we need to consider. Done now? Then they have given balance sheets of two companies, holding company and subsidiary company. Okay, great. I'll keep the face value in mind. I know that. Do you think balance sheet is of much essence over here? No much, because we got all the necessary information. Okay. So now you have to give me a quick walkthrough again. What is the first step in consolidated financial statement? Now little slowly. I want you to tell. First I give you an overview. Now you will tell me in detail each step. Then we will go through all the steps once again. First working note in consolidated financial statement. What is that? Shareholding percentage. What are we trying to find out through working note number 1? How much percentage shares in subsidiary company is held by holding company and how much in minority interest? Should we have to calculate that or given? Given. So here, how much is that? 80%. Correct? That means first working note we already clear. I think I already solved it here. I'll just click it off. So holding company owns 80%, means minority interest will own how much percentage, sir? 20%. Clear, sir? This is the working note number 1 in every consolidation problem. Some problems we may have to calculate shareholding percentage. Some problem they'll only directly give. So working note number 1 over. Tell me what is working note number 2? Preparation of general reserve of a subsidiary company. First of all, check the question, sir. Do you know general reserve? Does a subsidiary company have any general reserve? Does the subsidiary company have any general reserve? Check notes to account. Does a subsidiary company, do they have? Yes. So that means we'll prepare next working notice, general reserve of the subsidiary company. Sir, this data is on what? This data is from balance sheet, no? Balance sheet you prepare at year beginning or year ending? That means this data is as on 31st March 20x1. Okay. So that means whatever general reserve and P&L account that you see here, this is opening balance or closing balance. The general reserve and P&L that you see in balance sheet is a closing balance. Do you know the opening balance of general reserve? Current year begins on 1st April 20x0 and ends on 31st March 20x1. Sir, do you know the opening balance of general reserve? Yes, given in the problem. Check the adjustment here. The reserves stood at 25,000 on the date of acquisition. And what is date of acquisition? 1st April 20x0. So what is this 25,000? General reserve ka opening balance. So guide me, sir. When you prepare general reserve of subsidiary ka ledger working note, where will you show this 25,000? On the debit side or credit side? Credit side. You will write it as what? By balance brought down. Check, have we written that? So in general reserve, first we'll write by balance brought down. 25,000. Easy. Okay. Only opening balance is given or even closing balance is given? Closing balance. Come to the balance sheet. What is the closing balance of general reserve? 75,000. Where will closing balance of general reserve come in your ledger? On the debit side. To balance, carried down. 75,000. Easy. Everybody good? Okay. So now, sir, we read the whole problem. Any other adjustment we got it from general reserve or nothing? Nothing. Sir, this side total is 75, but this side total is only 25. Is the ledger matching or you're getting balancing figure? How much balancing figure? 50,000. So 25,000 opening became 75,000 closing. How? How can general reserve increase? It has increased by 50,000. How? Some 50,000 we have transferred from P&L to general reserve. So we'll write by P&L as the balancing figure. Is that okay? I'll tell you why we prepare this working note also. First, let's go ahead with whatever we need to do. So this is your second working note. Okay. Third working note is what, sir? P&L account of the subsidiary company. Sir, have they given P&L account of subsidiary company opening balance? Yes. Given as 15,000. Where will you write this 15,000? On the debit side, credit side, which side? Credit side, you'll write it as by balance brought down. How much, sir? 15,000. So in your P&L account, first you'll write by balance brought down 15,000. Okay, G. Similarly, check, sir. Have they given balance sheet of subsidiary company? Yes. Balance sheet you prepare at year beginning or year ending? Year ending. So do you know P&L ka closing balance? Yes. How much is P&L of subsidiary company ka closing balance? 25,000. Where will that 25,000 come? On the debit side as to balance carried down. Yes, sir. 25,000. Agreed, sir. Now, did you transfer any money from P&L to general reserve? Yes. What was the transfer entry? P&L account debit to general reserve. So same thing has to be posted in P&L also. So in posting in P&L will be to general reserve 50,000. Yes, sir. Correct. So any other adjustment is there in P&L account of subsidiary company or that's all? That's all. So what about depreciation? Sir, depreciation, has subsidiary done any mistake or it is consolidation adjustment? It is consolidation adjustment. Okay. We are only taking the data which subsidiary company has done. Okay. Depreciation also we'll do in a bit, not here. Okay. So now just check, sir. What is this side total? This side total is 75. This side also should be 75. Is it 75 or are you getting balancing figure? You're getting balancing figure. How much balancing figure? 60,000 you are getting as balancing figure. What is that, sir? What is that? What can come on the credit side? Check here. Opening balance of 15,000 became closing balance of 25,000 means how? P&L ka opening balance was 15. Okay. Closing balance is 25. That means P&L has increased means how it will be possible? Current year mein company has made some profit. So that balancing figure is nothing but current year ka profit which we get it as balancing figure. Okay. Yes, sir, everybody. So this is working note number 3 in consolidated financial statement wala problem. Till here, any confusion, anyone? Same working note. We have done almost 10 to 12 problems in consolidation with the same working note. Yes. So it should not be a problem ideally. But I know that some of you might have not studied from me and directly watching this. That's the reason I'm taking it a little slow. Okay. The same format I'll follow for all the questions. I suggest stick to the same thing so that all the consolidation adjustments you can tackle with this format. Okay. I have explained the logic of each component, but right now I'll not have time to go into each component. Few things, whatever is important, I'll go on spending time on that. Okay. All right. What is working on number 4 we do, sir? Analysis of reserves and surplus of subsidiary company. Sir, subsidiary company ka reserves and surplus, where do you show again in balance sheet? Shareholders funds. That means reserves and surplus of subsidiary company belongs to whom? Shareholders of subsidiary company. And who are the shareholders of subsidiary company? Holding company and minority interest. So all the reserves and surplus of subsidiary company will be split among holding company and minority interest in their respective shareholding percentage. H ka shareholding percentage is 80%. Minority ka shareholding percentage is 20%. In this ratio, we go on splitting. And do we do this allocation on a total basis or each component by component basis? We look component. Each component of general reserve, P&L account, ledger we will take and go on distributing among holding company and P&L or holding company and minority interest. Okay, check this. First component in general reserve. So before you do the split, no, before you allocate, you need to know whether the reserve is a pre-acquisition profit or a post-acquisition profit. Pre-acquisition profit means what, sir? Those reserves and surplus which were already existing before holding company got the control. On the day holding company got the control, reserves and surplus were already existing. Such reserves and surplus of subsidiary company, we call it as pre-acquisition profits. Don't be misled with the word pre-acquisition profit. Profit here refers to pre-acquisition, all the reserves and surplus. Agreed? And this pre-acquisition profit, sometimes we also call it as capital profit. Post-acquisition profit ka another name is revenue profit. So sometimes in our study material, instead of pre and post, you may also see the word capital profit and revenue profit. This is just an alias, another name, that's all. Okay. Now, sir, when did you get the date of control? Tell me that first. What is the date of control? Date of control is 1st April 20X0. Holding company got the control or holding company bought 80% shares in subsidiary company only on 1st April 20X0. Now, first component of general reserve is what, sir? Opening balance. This opening balance came after holding company became shareholder or it was already existing? It was already existing. So this, sir, this 25,000, should I put it under pre-column or post-column? I should put it under pre-column because this was already existing. Any reserve and surplus which is already existing on the date of control, that only we call it as pre-acquisition profits. Yes. So this 25,000 we will give, this is a total. Yes, no? Each component by component will go on distributing. So this 25,000 split in 80-20 ratio. What will be the split up? 20,000 and 5,000 rupees. This is your opening balance of general reserve. Easy, sir. Okay. Now, this is over. Okay. What is the next component? P&L account 50,000. Sir, this 50,000 came from general reserve or it came through P&L? Came through P&L. Anyway, P&L also we're going to distribute. That means should I have to worry about this for the time being or not required? Not required. When I do the P&L distribution, this 50,000 will be taken care of. Correct? So that means should I have to worry about that or tick off? Tick off. Sir, these two ka summation only is what? Closing balance. No. So if these two are already apportioned, means indirectly closing balance is also apportioned. So general reserve ka any more drama pending or fully over? Fully over. Can I move on to the next one? Like the same activity we have to repeat for all the reserves and surplus. Other than general reserve, what are the other reserves we have here? We have P&L. So do you know P&L ka opening balance? Yes. How much? 15,000. Opening balance means this came after holding company got control or was there before only? Before holding company got control in subsidiary company, this opening balance of P&L was already there. So this 15,000 where I should put? Under pre-column, post-column, which column? Under pre-acquisition profit. Under pre-acquisition profit, you will say opening balance of P&L 15,000. This 15,000 also you distribute among the parent and subsidiary company or the holding company and minority interest in the ratio of 80:20. That will be what, sir? 12,000 and 3,000 respectively. Done now? Okay. Now check here, sir. Current year profit. Current year profit means it is 1 month ka profit, 2 months ka profit or whole year ka profit. This is whole year ka profit. 1 minute. When did the holding company get the control in subsidiary company? 1st April. On the first day only they got control. That means entire current year profit was made by the subsidiary company after holding company became shareholder. Is my statement right or wrong? Entire profit of subsidiary company has been made only after holding company has got the control. Yes, no? That means this was there before holding company got control or it came later? This 60,000, this 50,000 came later. So where should I show this 50,000 under? Pre-column or post-column? Post-column. Under post-column, we'll show current year ka profit, which is how much, sir? 60,000. The 60,000 also you distributed in 80-20 ratio. So it will be 48,000 and 12,000 respectively. Okay, G? Yes, this is one. Okay, these two are done. Okay, add these two, sir. How much is it? Add these two, how much is it? 75,000. Yes, correct. Out of this 75,000 only, 50,000 you have transferred to general reserve. Hence, closing balance is how much? 25. Totally you had 75. Opening balance of profit was 15. Current year profit was 60. So total profit you had was how much? 75. In this 75, 25 you transferred to general reserve. So how much is profit remaining? 25,000. Sir, did I distribute entire 75? Have I distributed entire 75? Yes. Hey, no, this 15,000 also I have distributed. This 60,000 also I have distributed. So entire 75 I have any which way distributed. So should I have to worry about this 50,000 transferred to general reserve? No, because out of 75 only I have transferred to general reserve. No, that means this 50,000 has come from this 75 only. No, and entire 75 already transferred. Okay, sir. No, sir. If you transfer to general reserve, P&L balance will reduce. No, sir. That means you should not transfer 60,000, sir. You should do 60 minus 50, sir. If you think on those lines, yes, you're right only. Out of 60, how much have you transferred to general reserve? 50,000. But how much have I distributed? 60. That means what do you have to do? You have to minus. How much you have to minus? 50,000. Correct? This 50,000 went where? General reserve. General reserve also will be. General reserve is also a reserve. What will that be reserve? What will you do for that reserve? No. Again, distribute. So required. First you will reduce. Then again you will distribute. Required or not required? Not required. So don't worry about that now. Okay, fine. Because anyway, you would have transferred money from money to general reserve only either from opening balance or current year profit. So both opening balance and current year profit is fully any which way distributed. So transferred to general reserve, you need not worry, or this will not come in your working note number 4. Is my statement absolutely okay for everybody? Okay. And what about closing balance? Should I have to worry or already taken care of? Already taken care of, because in the 75, if you deduct 50 only, you're going to get 25. Since I've distributed entire 75, these two are automatically taken care of. Yes, Saru? Okay. So now, that's all. Usually, that's all will be there. But in this problem, 2 extra components are there. Can anyone remind me what is that? Revaluation adjustment. Was any asset revalued? Yes. Check here. We already wrote that. Yes. Machinery ka book value was how much, sir? I'll retrace your adjustment as you once again here. Look at it. Book value of the machinery was 1 lakh. But was the revalued amount 1 lakh or 1,50,000? 1,50,000. That means, do you have revaluation loss or revaluation gain? You have a revaluation gain, how much, sir? 50,000. Any problem? Sir, asset came after holding company acquired the shares, or it was there much before? Asset was there much before. So this revaluation gain, you will put it under post column or pre column. This revaluation gain, this was there already when the asset was already there when holding company acquired the shares. Before holding company acquired the shares only, this asset was there. So this revaluation gain, you should put it under post column or pre column? Pre-acquisition profit side. Correct, everybody? So check, have we shown revaluation gain under pre-acquisition profit side? This is your pre-acquisition profit. Revaluation adjustment on plant and machinery is how much? 50,000. Understood, sir? This is nothing but your revaluation reserve. What will you do for all the reserves in surplus? Distribute. Among whom? Shareholders. Who are the shareholders of subsidiary company? H Limited and minority interest. In what ratio will you do the split up? 80% and 20%. This 50,000 also you split between 80 and 20 ratio. Agreed, sir? This is the revaluation gain on plant and machinery. You have only revaluation gain or you have revaluation loss also? Revaluation loss also. On what asset? Another different asset called furniture. Furniture ka book value was 20,000. But revalued amount is only 50. Sir, book value is 20. Market value is only 50. That means it's a revaluation loss. Correct? So revaluation gain you added. That means revaluation loss you will subtract. Correct or no? So where will this revaluation come? Sir, asset came after holding company became shareholder or was already there? Already there. That means this loss you will put it under post column or still pre column only? Pre column only. So revaluation gain means you are giving us positive apportionment. So revaluation loss will be negative apportionment. Easy, sir? Same. Distribute in 80-20 ratio. So it will be 4,000 and 1,000 respectively. Done now? Is this the only adjustment that comes, or relating to this one more will come? Relating to this one more will come. Which is what, sir? Sir, subsidiary company has charged depreciation on plant and machinery at 1 lakh. And they've charged depreciation at the rate of 10%. Correct? But for consolidation purpose, should we consider 1 lakh or 1,50,000? We should consider 1,50,000. So on how much asset has subsidiary company not depreciated? On how much asset subsidiary company has not depreciated? 50,000. So what is the rate of depreciation? 10%. So 50,000 into 10 is how much, sir? 5,000 rupees. Or if you want, you can work it out like this also. Like subsidiary company has calculated depreciation at 1 lakh. 1 lakh at 10% is how much? 10,000. Okay. And after deducting depreciation, how much is asset value? 90,000. Check, has subsidiary company showing plant and machinery at 90,000? Check your working note number 2. Plant and machinery, they are showing it at 90,000. Because from 1 lakh, they have depreciated 10% and then the book value has become 90,000. Agreed? Now come back. For consolidation purpose, can we consider 1 lakh or should we consider 1 lakh 50,000? We should consider 1 lakh 50,000 because we have to take not the book value but the market value. That means we have to depreciate not on 1 lakh, but we have to depreciate on 1 lakh 50,000. So 1 lakh 50,000 ka 10% is how much? 15,000. That means the subsidiary company should have depreciated 15, but they've charged depreciation of only 10. So how much depreciation they've not charged? 5,000 rupees. That means now we need to charge the depreciation. Yes or no? That means due to revaluation, you are getting less depreciation or more depreciation. Due to revaluation gain, you are getting more depreciation. That more depreciation, I'm calling it as excess depreciation. Is it okay? So should we charge this or ignore it? We should charge. So depreciation, you will charge it on the date of control or at the end of the year. Depreciation comes on the date of control or end of the year? End of the year. Yes. That means this depreciation adjustment will come under pre-acquisition profit side or post-acquisition profit side. It will come under the post-acquisition profit side because normally we charge depreciation only at the year end. So on machinery, you will get extra depreciation. You should put it under post-acquisition profit. Okay, sir. How much is that extra depreciation? 5,000. Now you tell me, when you're charging some extra depreciation, P&L balance will be same or it will reduce? If you have to charge more depreciation, means P&L balance will be same or it will reduce? It will reduce. Hence 5,000 should I distribute as positive apportionment or negative apportionment? This is not ledger. This is a statement. So if a component balance is increasing, means I will show it as positive number. If a component ka balance is reducing, means we'll show it as a negative number. So due to this depreciation, machinery ka value will reduce. In fact, P&L balance also will reduce. Hence that's the reason we have to show this as what, sir? Negative number. Okay, sir. So this 5,000 also will be distributed among whom and whom? Minority interest and holding company 80-20 ratio. 5,000 in 80-20 ratio you do 4,000 and 1,000 respectively. Yes, sir. Okay. Is this the only adjustment of depreciation or one more? Sir, even furniture you revalued. Correct? Furniture also you revalued. What is the book value of furniture, sir? 20,000. What is the rate of depreciation they've charged on furniture? 15,000. That means subsidiary company has charged how much? 20,000 ka 15%. They have charged how much? 3,000. But for consolidation purpose, are we considering book value or market value? Market value. And what is the market value of the asset? 15,000. That means on how much value you should have depreciated this asset for? 15,000. At what rate? 15%. So how much depreciation you should charge for consolidation purpose? For consolidation purpose, you should only charge 2250. But subsidiary has charged 3,000. That means now you have to charge more depreciation or reverse. You have to charge more depreciation or reverse. Subsidiary company has already charged more. You need to reduce that. That only we call it as reversal of depreciation. Understood? So how much is the difference between these two? 3,000 minus 2250 is how much? 750. Either like that you can do, or simply you take on how much value subsidiary company has charged excess depreciation. 5,000. Take 5,000 into 15%. It will become 750. The choice is yours. Okay, Nasaru? Alright, now this 750 ka reversal of depreciation will come under pre or post? Post, because there's a depreciation. Depreciation will come on the date of control or at the end of the year? End of the year. So this 750, where it should come? Under post acquisition profit. Now, are you charging more depreciation or are you reversing? Sir, if you account more depreciation, P&L balance will reduce because depreciation is an expense. When you account more expense, P&L balance will reduce. Here you are accounting more expense or you are reversing the expense. Reversing the expense means you are reducing the expense. If you reduce the expense, P&L balance will increase. So this 750 will cause what impact on P&L? It will increase the P&L. So I should show this as a negative apportionment or positive apportionment? Positive apportionment. Under post-acquisition profit, 750 will show it as positive apportionment. The 750 also distribute between holding and minority in 80-20 ratio. The apportionment will be 600 and 150. Everything ticked off. Rest is the total. So this is the pre-ka total and this is post-ka total respectively. Yes, sir. Sir, why do we do this pre and post, sir? I'll tell you. Let me drink some water. Okay, or else you tell me, why do we split between this pre and post? Online, respond. Why do we split the reserves in surplus pre and post? Why can't we do it in one shot? What is the intention of splitting subsidiary ka reserves in surplus into pre and post? Another way to put it across is, sir, pre-acquisition reserves in surplus means it was already there when holding company became the shareholder. It was already there when holding company became the shareholder. So logically, you think something which was already there, is holding company put any effort to get that? No. So logically, should holding company get any share in that? Some P&L balance, some reserves in surplus, holding a subsidiary company already had. That means now holding company has 80% in subsidiary company. That means whatever subsidiary company has, 80% of that belongs to holding company, right? But all these reserves in surplus were there much before holding company became the shareholder. That means logically, should holding company get it? No. But practically, will they get it? Yes. Because company works on what approach? All or nothing. The day you became shareholder, whatever company has, everything belongs to you as a shareholder. The day you leave the company, nothing belongs to you. It's like that. It's like our life. When you have, everything is yours. When you're gone, nothing is yours. Yeah, like that. So company works like that because it is very difficult to apportionment. Why we do this concept is, let's say, sir, I bought the Reliance ka share at 10, now it's about 1040. I bought Reliance ka share at 1040. I sold it at 1045. I bought it at 1040 now. I sold it within 5 minutes. Can I write a letter to Infosys and say, 5 minutes I was holding your share, give me 5 minutes ka dividend. Give me 5 minutes ka dividend. Possible? No. So hence the company works on what approach? All or nothing. The day you are shareholder, everything is yours. The day you quit, the day you sell the share, nothing is yours, like that. So this pre-acquisition profit, how much is H Limited ka pre-acquisition profit, sir? 68,000. This 68,000 was there much before holding company became shareholder. So logically, should they get it? No. Practically, are they entitled to get? Yes. Hence, what the standard says is, this pre-acquisition profit, no, reduce it from cost of investment. This pre-acquisition profit, reduce it from cost of investment. Now, think why. What is the cost of investment? How much did holding company pay to get control in subsidiary company? 1,60,000. That is given in balance sheet only. Check here. And they prepared note number 4. Come to note number 4. Shares in S Limited. How much did a holding company pay to get shares in S Limited? 1,60,000. There's only your cost of investment. Now you think logically, cost of investment is 1,60,000. On one hand, holding company is paying 160. On another hand, they are entitled for pre-acquisition reserve of 68. So is your cost really 160 or lesser? On one hand, you are paying 168. On the other hand, you are getting back 68,000. That means is your cost really 160 or less? Less. Hence, pre-acquisition profit we need to reduce. Since this pre-acquisition profit you have to reduce, no, that's the reason all the reserves you need to split as pre and post. Otherwise, splitting was not necessary. Only because of this adjustment, you have to do every reserves in surplus, you have to split it as pre and post. Nana Sarji. Sir, what about post-acquisition profit, sir? So post-acquisition profit came after holding company became the shareholder. So should they get it? Yes. Practically, will they get it? Yes. So this is what, sir? Abnormal item or normal? Normal. This is your normal profit, no? Normal profit, you will transfer it to normal P&L. So here we prepare consolidated P&L. So this 44,600 will be transferred to consolidated P&L, which we will transfer in a bit. I'll get to that. Is that okay with you? So did you get the adjustment for this? Okay. So first maybe we'll finish off goodwill working out and then do minority interest. So how do you get goodwill? I told, sir, we revise this. Tell me once again, what is the goodwill step? First you take cost of investment. Then you reduce if you have any pre-acquisition profits. I'm using the word profits. Does it mean profits only or it's all reserves in surplus? All reserves in surplus. This just for the sake of wordings, we have used profit. If it is confusing for you, you can write pre-acquisition reserves in surplus. It is fine. Okay. Then if you have any pre-acquisition dividend, reduce it. Then compare it with face value of share capital. Okay. Now check. That's what we will do over here. What is the cost of investment? 1,60,000. We have to reduce pre-acquisition profit. Yes. Is there any pre-acquisition dividend there in this problem? No. So what does pre-acquisition dividend means? Sir, any dividend given out of pre-acquisition profit. Any dividend paid out of I'll write it here for your reference. Any dividend, it is there in your chart book. I can again take you through that. Any dividend paid out of pre-acquisition profits is what we call it as pre-acquisition dividend. Okay, Saru? All right. This is one. It's there in your AS 13 also. We'll apply this in the next. I'm not taken this pre-acquisition dividend question here because after this topic, I'll take in AS 13 investment accounting. There also it will come. So that's the reason I've kept this. I've chosen this question because this is the better question. That's the reason. Pre-acquisition dividend will come in the next AS 13 question I've chosen. There also it will come. But quickly I'll tell you, pre-acquisition dividend means any dividend paid out of pre-acquisition profits. Now think logically. Pre-acquisition profit means should holding company logically get it? Pre-acquisition profit of subsidiary company means should holding company logically get it? No. Why? Because these profits were made much before holding company became shareholder. Yes. So pre-acquisition profit only they should not get. Now pre-acquisition dividend means what? Dividend paid out of pre-acquisition profit. So logically you think if any dividend is given out of pre-acquisition profits, such a dividend should be given to holding company or no? Because it is paid out of what profits? Pre-acquisition profits. And was a holding company there when that pre-acquisition profits were made or they were not there? They were not there. So logically, should holding company get this pre-acquisition dividend? No. But practically, will they get it? Yes. Okay. Now you tell me, you paid 1,60,000 to buy the investment. One hand may you are getting pre-acquisition profits. Another hand may you are also receiving pre-acquisition dividend. So is your cost of investment really same or it has reduced? Reduced. So since you are receiving pre-acquisition dividend, cost of investment will not be 160, it will be lesser. Is it okay, sir? And AS 13 also says this. Actually, pre-acquisition dividend is not a concept of consolidation. It's a concept relating to accounting standard. 13 relating to investment. What AS 13 says is, if you have received any pre-acquisition dividend, what is the journal entry for dividend received, sir? Bank account debit to. 1 second. 1 minute. Yeah, I think it's fine. All right. Yes. So bank account debit to, what is the journal entry for normal dividend, sir? Bank account debit to dividend. And dividend as an income and you will transfer that to P&L account. So first you'll write bank account debit to dividend income account. And then second entry will be dividend income account debit to P&L account. Correct, no, sir? This is the journal entry for what dividend? This is the journal entry for normal dividend. If you have received normal dividend, then this is the journal entry. Not dividend paid. This is a journal entry for dividend received. Normal dividend received. Sir, are we talking about normal dividend here or pre-acquisition dividend? Pre-acquisition dividend. If it is pre-acquisition dividend, what the standard says is holding company has received. Because if subsidiary company has declared the dividend means dividend will be paid to whom? Shareholders. Who are the shareholders of subsidiary company? Holding company and minority interest. So has holding company received any dividend? Yes. What entry holding company will pass? Bank account debit. Let's say dividend amount is 10,000. Bank account debit 10,000. You can't credit dividend income account. Is this your normal dividend or pre-acquisition dividend? If you have any pre-acquisition dividend, what we have to do? Reduce the cost of investment. Same thing AS 13 also says. Any pre-acquisition dividend should be reduced from cost of investment. Sir, investment is a liability or asset? Asset. Assets have what balance? Debit balance. Due to pre-acquisition dividend, that asset balance is same or is it reducing? It is reducing. Something which has debit balance, how do you reduce it? Credit it. So what is the journal entry for pre-acquisition dividend? Bank account debit to investment account. Now you tell me, because of pre-acquisition dividend, what will happen to your cost of investment or what will happen to your investment value? Same or it will reduce? Reduce. So what have I written here? If there is any pre-acquisition dividend, reduce. In this problem, is there any pre-acquisition dividend? No. If it comes in the problem, do you know what to do? Yes. Just bring it into this working mode. Because due to pre-acquisition dividend, your investment value will reduce. Understood? Okay. So do this plus minus, sir. How much are you getting? Only do this 160 minus 68 to do. How much are you getting? 90. 92,000 is the net cost of investment. Agreed? Sir, what is the share capital in subsidiary company? What is the share capital of subsidiary company? 1 lakh. Entire 1 lakh belongs to holding company or only 80%? Only 80% because 20% belongs to other guys. Other guys we call it as minority interest. So what is the share capital? 1 lakh. But holding company ka share is only 80,000. Sir, the worth of the investment is 80,000. But how much did holding company pay to get control? 92,000. Worth of the investment is only 80,000, but holding company paid 92,000. So that means did they pay less or more? Holding company paid less or they paid more? For 80, they paid 92. Cost of investment is 92. So they paid 92, but the worth is only 80. So holding company paid more, right? If you're paying more means holding company has made profit or they made loss. That loss only is called as what's a goodwill. How much is that? 12,000 rupees. Easy. I'll show you another method to get the same answer as well. But whenever they give you a full-fledged, I think I mentioned this also. Whenever they give you a full-fledged question of consolidation, solve it in this format only. There is another way to work it out also. Okay, which I'll show you here also. I have told you in regular class, now also I'll tell you, but follow this only for bigger problems. For shorter problems, I'll take you through that also. You can follow the other method. So far are we good? So this is the thing. So here, what did we get, sir? Good. 12,000, that is nothing but your goodwill. Suppose you got this as a negative figure. That means holding company has made profit. Revenue profit or capital profit? Capital profit. That means you will transfer that where? To capital reserve. That way. Yes, sir G. Okay, this is about working note number 6 for cost of control. Before this, we prepare one more working note for minority interest. So minority interest are the shareholders of subsidiary company. What and all shareholder will ask, sir? If you are a shareholder in subsidiary company, what and all you will ask? Your share of share capital, your share of pre-acquisition profit, your share of post-acquisition profit. So minority will only ask for 3 things. What is the share capital of subsidiary company? 1 lakh. Entire 1 lakh belongs to minority interest or only 20%? 20%, because minority interest owns only 20%. So 1 lakh or 20% is how much? 20,000. Okay, pre-acquisition profit. So do you know pre-acquisition profit? Yes. What is minority interest ka their share of pre-acquisition profit? 17,000. Considered a yes. That's all, or even post-acquisition profit. Post-acquisition profit. Minority interest ka their share of post-acquisition profit is how much? 11,150. So add all this, how much are you going to get? 48,150. Are we good, sir? Okay. Sir, why we can't do the same working note for holding company, sir? Because holding company is also shareholder, sir. So why can't we do it, sir? We can't do it like that, sir, because holding company has purchased investment in a subsidiary company. Think from holding company perspective, this holding company, this investment is an asset. Investment is an asset. Where did they invest in? They invested in equity shares of subsidiary company. That means indirectly can I say subsidiary company has issued equity shares to holding company. Subsidiary company has issued equity shares to holding company. I mean subsidiary company has issued equity shares means they will show it as equity share capital. Same component for one company it is an asset. For another company it is a liability. Now are you preparing individual financial statement or consolidated financial statement? Consolidation. That means you're treating both the company as one. Same component you can show both as an asset and as a liability. No. Both as an asset and liability, same thing you will show? No. Hence both will be shown or both will be netted off. Both will be netted off. That netting off will happen in working note number 6. Is that okay with you? Okay, that is what we've done here. So investment also will get cancelled. Face value of share capital also will get cancelled. Instead of that, what will come? Goodwill will come. So entire share capital cancelled? No. I only considered 80%. Why? Holding company only owns 80%. So what about other 20%? Give it to minority interest. That's the thing. Okay, that's the reason. The way you present working note number 5, same fashion way you can't present working note number 6. Because holding company is showing already some investment. Same company cannot be shown both as an asset as well as a liability. Hence, both will get nullified and instead of that, what will come? Goodwill or capital reserve will come. And that goodwill or capital reserve will come as part of working note number 6. This is the drum. Need a minute to process or next one? Okay. Last working note is working note number 7. Sir, what is the P&L balance of holding company? Already given in the balance sheet 1 lakh. Sir, due to consolidation, this balance will not be 1 lakh. It will change. Due to consolidation, this balance will not be 1 lakh. It will change. So that's the reason we have to find last working note we need to prepare for reserves and surplus. Initial problems, if you remember, I used to prepare this as a ledger. Then I told you, if you prepare ledger, no, you'll only be able to capture P&L balance. Other reserves and surplus, you will be able to miss out. Hence, I told better format is what, sir? 1 or 2 problems I solved like this in class. Then I shifted over to another format and told you present it in statement format. Because in statement you can capture, if you have 10 reserves, all the 10 reserve information you can capture in statement format. Okay, first thing what you do is check, sir. What and all reserves and surplus Holding company has, not subsidiary company. Subsidiary, don't bring in subsidiary company reserves in surplus now, because subsidiary all the reserves you are split between H and minority interest. So reserves in surplus of subsidiary company is full done. Only holding company what is the reserve we have? First reserve we have, what is it? General reserve. Check, have we taken general reserve 2 lakh? Yes, let us come. Next, do we have any? Do not forget capital reserve. In this problem, we got capital reserve or we got goodwill. We got goodwill. Some problems you might get capital reserve. If at all you get capital reserve, bring that in also. Don't forget that. That is one. Okay. Next, what reserve holding company has other than general reserve? They also have P&L. What is a P&L balance, sir? 1 lakh rupees. Considered 1 lakh. 1 minute, it's loading. 1 lakh considered. Yes. Now, sir, subsidiary company ka reserves in surplus you split between 2 parts. Can you tell me what are those 2 parts? Pre-acquisition profit and post-acquisition profit. Pre and post. Pre-acquisition profit, you already reduced it from cost of investment. Minority share of pre and minority share of post is already distributed them. What is one component which is still not distributed? Minority ka full pre and post distributed. Holding company ka pre already considered. What is one component missing? Holding company ka post acquisition profit, which is how much? 44,600. Post acquisition profit means these profits were made by subsidiary company after holding company became shareholder. So logically, should H be entitled to holding company should be entitled to get it? Yes. Practically, will they get it? Yes. So this is your normal profit. So that means your P&L balance will be 1 lakh for consolidation purpose, or it will increase. This is 1 lakh is as per H Limited ka balance sheet. Are we preparing only H Limited ka balance sheet now or combined balance sheet? Combined balance sheet of H and S. So do you have any consolidated post acquisition profit? Yes. How much is that? 44,600. So that means add that. Done now. Along with this, extra things will come. Sometimes in the problem, what they'll say is, sir, what is the correct journal entry for pre-acquisition dividend? Correct journal entry for pre-acquisition dividend? Bank account debit to dividend. Bank account debit to dividend, rather bank account debit to dividend or bank account debit to investment. Bank account debit to investment is the correct journal entry. But you know what our super duper accountant would have done? He would have credited it to P&L account. Instead of crediting investment, they will say in the adjustment. In this problem, it is not there. In the examination questions, if you get pre-acquisition dividend, this adjustment, 99.99999% it will be there. What they will say is, this dividend, this pre-acquisition dividend, ideally you should adjust it against what? Cost of investment. That means what should be credited? Investment. But they'll tell in the problem, P&L account has credited. When will P&L account get credited? If it is your normal dividend. What is the journal entry for normal dividend, sir? Bank to dividend. Dividend to P&L. So if you add these 2 entries, what are you getting? Dividend debit, dividend credit, nullified. Effectively, what is the journal entry? Bank to P&L. So that means our super duper accountant, instead of treating it as pre-acquisition dividend, he treated it as normal dividend. That they will tell in the adjustment. In this problem, do we have it or not there? Not there. If it is there, what to do is what you need to understand. Now, sir, he has treated dividend as a normal income. So this normal income he has transferred where? To P&L account. Who has received the dividend? Holding company. Okay, and holding company ka accountant has treated this as normal dividend, means he has treated it as an income and transferred this income to P&L. Because of this, what will happen to holding company ka P&L balance? Unnecessarily increased. Should this income go to P&L or it should be reduced from cost of investment? It should be reduced from cost of investment. But unnecessarily P&L has been increased. So what to do? P&L balance we need to reduce. So if you have any pre-acquisition dividend from working note number 7 also you need to reduce. Understood? Huh? That they will give. In this problem it is there or not there? Not there. Okay, Saru? And last adjustment is stock reserve. Stock reserve means I already told you this stock reserve will come and holding company has sold goods to subsidiary company. Holding has sold goods to subsidiary company. Do you think sale would have happened at cost price or selling price? Selling price. So some profit element is included in closing stock. That only we call it as stock reserve. Now, holding company and subsidiary company are 2 legal companies, separate companies. Can one company make profit from the other? Yes. But for consolidated purpose, are we treating them as 2 companies or one company? One company. So can you show this profit or you have to eliminate? In consolidated financial statements, since you're treating them as one company, all this unrealized profit you cannot show. Because if you show, it look like you made profit from yourself. Okay. You made loss to yourself. It will look like that. So because we are not treating them as 2, we are treating them as 1. Hence, unrealized profit you need to eliminate. Here, who sold the goods to whom? H to S. H to S. So who made the profit? H. That means H Limited ka profit is unnecessarily increased. Hence, we have to reduce. Correct? So, suppose it is H, subsidiary has sold goods to holding company means, sir, if subsidiary company has sold goods to holding company means, in this case, who would have made profit? Subsidiary company. Subsidiary company ka profit you show it under analysis of profit of, here you do know, here you bring it in. Here under post acquisition profit you bring it in. Okay. So you have to, due to this adjustment, P&L balance should increase or reduce. P&L balance should increase or reduce? Reduce. So what you will do is, if you have any unrealized profit, under post acquisition profit, you will write less stock reserve. Less stock reserve, whatever is the amount. Here the amount is 0. Okay. So you will reduce it from here. Is that okay? Because who made this profit? Subsidiary company ka. So subsidiary company has made the profit means it will come in working note number 4, because subsidiary company ka P&L and reserves and surplus analysis only we are doing in working note number 4. That's the reason. Done now, people? Okay. This is about the steps. I will do that. Yes, so far good. So this is all the working notes. In fact, the requirement of the question was only to prepare consolidated balance sheet. Consolidated balance sheet is the easiest. These working notes, 7 working notes are the most important. In all the 7 working notes, working note number 4 is the most important, because maximum number of adjustments will be there over here. If you get this right, I am 100% sure that you will not do any mistake. Okay. Now, can we quickly run through consolidated balance sheet? What are the steps? Now, sir, consolidated balance sheet is very, very simple, because take holding company ka balance sheet data. To that you add subsidiary company ka balance sheet data. That's all. Okay. Blind addition or 1 or 2 components are there? 1 or 2 components are there. Let's test our memory. What and all we remember? Tell me, or you tell me how much you remember. Let's see. First, sir, I'll give you an idea. Each component I'll discuss. You tell me. Sir, holding company ka share capital is 6 lakh. Subsidiary company ka is 1 lakh. Both you will add or only holding company ka? Only holding company ka. So I'll only tell the answer. This 1 lakh will not come. You need to tell me the reason why. Why subsidiary company ka share capital will not come in consolidated balance sheet? This will not come. Only 6 lakh will come. That is the answer. Why? Yes, sir. S limited ka showing as 1 lakh. No, that is share capital. For S, it is share capital. For H, it's an investment. Both same component you will show both as investment and share capital, or it will get nullified. It will get nullified. The share capital also will get nullified. The investment also will get nullified. Instead of that, what will come? Goodwill or capital reserve. Okay, na sir. Hence, this will not come. Or another logic is, when you are a shareholder, when holding company is a shareholder, they'll be able to control subsidiary company. What they will be able to control a subsidiary company? Share capital and reserves and surplus, or assets and liability? What you can really control is assets and liability. So, or in layman terms, if I have to put it across, only subsidiary company ka assets and liability will be added 100%. Only subsidiary company ka assets and liability will be added 100%. Subsidiary company ka share capital and reserves and surplus will not. That's another logic. Is that okay? Because you can't control them. What you can control over here? Or another way, I think that is the previous explanation, I think was a lot more sensible for us. I think for one company it is share capital, for another company it is investment. Same component you cannot show both as an asset as well as a capital. Hence they will get nullified. Okay. Okay. And what about reserves and surplus? Reserves and surplus is already distributed among holding company and minority interest. So this will not come. 3 lakh also will not come. We have already done working note. No, working note number 7, where we prepared consolidated reserves and surplus. Check what is our consolidated reserves and surplus. 1 minute. 3,44,600. Check the balance sheet. Have they shown 3,44,600? I think I prepared that also here. Yeah. Reserves and surplus is 3,44,600. Who share capital will come? H and S ka or only H ka? Only H ka share capital we have shown. Subsidiary ka not shown. Done, sir? Okay. Sir, now 1 minute. Now, one more component should come under the share. Normally, after shareholders funds, what do you issue? Non-current liability. After that, current liability. Before non-current liability, one more you need to show. What is that one more? Minority interest. You should also show minority interest. Sir, do you know what minority interest ka balance? Do you already know? Yeah, check working note number 5. What is minority interest ka balance? 48,150. Check the balance sheet. Have they already shown 48,150 minority interest? Here 48,150. Okay, why? I'll tell you in a bit. Okay, for now you need to show. Next is what, sir? Non-current liability. We saw the balance sheet. Do we have any non-current liability? No. Next, what do we have in the balance sheet? Check. We have some trade payables, current liability. So this and all assets and liability, you add 100%. So add these two. How much is this? 207. But if there is any MO, reduce. What is MO? Mutual owing. Same. Amalgamation ka those concepts and all are same. So if there is any mutual owings, meaning holding company has some debtor receivable from subsidiary company. So holding company is showing it as debtor, subsidiary company is showing as creditor. So holding is a separate company, subsidiary is a separate company. But for consolidation purpose, are you treating them as two companies or one company? One company. That means one company is showing as a debtor, another company is showing as creditor. Are there two companies now or only one? Only one. So who will pay whom? Nobody. So hence, if there is any mutual owings, you need to reduce. In this problem, did we find any mutual owings? No. So add up this. How much are you getting? 2,07,000. Check, have they taken 2,07,000 in your balance sheet? Where is that part here? 1 minute. 2,07,000. So balance sheet total done. Done, G. Okay. Next is your assets. Under assets, you will show property, plant and equipment. First PP is your machinery. Okay, let's come back to the question card data. For I think they prepared notes to accounts. We'll take it from here. So what do you do for assets and liabilities? 100% addition. So what is holding company ka plant and machinery? 90,000. Okay. Subsidiary company ka you take 90,000. Okay. But this 90,000 is a book value. Are we taking book value for consolidation purpose or market value? Market value. So compared to book value, your market value was more, no? You got some revaluation gain, right? Yeah, how much was the revaluation gain on machinery? 50,000. Can we ignore this or add this also? Because we can't consider book value for consolidated financial statement. We have to consider market value. But currently subsidiary company has considered book value, no? So compared to book value, how much is the revaluation gain? 50,000. So add that 50,000 here. So 1 minute, or I think we have it showing here, no? Okay. It's taking a lot of time to load. Too many things, I think. Okay, add 50,000. Correct, sir? Sir, this is revaluation gain, but you got only revaluation gain, or due to revaluation gain, you got some extra depreciation also. You got some extra depreciation also. How much is that extra depreciation? 5,000. That means what is the machinery value? 390, 440, so 435. 435 is the machinery ka final value which will come in your balance sheet. Agreed, sir? Later we'll check. For now we'll update. Is that fine? Same data we have to do it for furniture. Holding company ka furniture is, I think it is not 0, it's come alignment error. This is okay. Machinery is 1,50,000. It's come below. And subsidiary company ka is 17,000. On machinery, you had revaluation gain or revaluation loss. You had a revaluation loss of 5,000. And due to revaluation loss, we got excess depreciation or we have to reverse depreciation. Sir, when you charge depreciation, asset value will reduce. Here you are charging or reversing? Reversing. So due to reversal, asset balance will increase. So add this. How much is this now? 167, 162, 161, 250. Yeah? 162, 750. Yeah? Paka? Yes. Okay. So this is the value. So they have considered this. Check 435 and 162, 750. 435 and 162, 750. Total is 597, 750. Got it? That's what I've written over here. Take the data as given in the balance sheet. If there is any revaluation gain, add it. Due to revaluation gain, if you are getting more depreciation, reduce it. For furniture, take the balance sheet data. If you have revaluation loss, means subtract. Due to revaluation loss, you will get excess depreciation or reversal. Reversal. So add the reversal of depreciation, you will get the value. Done, Asaru? Okay. Next. What is the next? So PP already considered. Next is investment. Sir, investment will not come, sir. One second. Yes. Investment will not come. Whose investment will not come? Investment made by holding company in subsidiary company. Only that will not come. But always check. Have they prepared any working note for investment? Yes. Come to working note number 4. What are they telling? So total investment for holding company is how much? 6 lakh. Entire 6 lakh did holding company invest in subsidiary company or only 160? Out of 6 lakh investment, only 160 ka investment is made in subsidiary company. 440 is made in other investment. This 160 will come in consolidated balance sheet? No. Why? Because for holding company, it's an asset. For subsidiary company, it is share capital. They will get knocked off, and instead of that, what will come? Goodwill or capital reserve will come. So this will not come. How about other investment? Other investment, will it come? Yes. Add these two. How much is this? This will be 5,90,000. Yes, Asaru? So check, have they taken 590? 5,90,000 is your other investment. So I told you should not forget goodwill or capital reserve. Here we got goodwill. No? So how much is the goodwill we got? As per working note number 6, 12,000, which is being brought in over here. Okay, na sir? All right. What are the other components in balance sheet now? This is over. This is over. What else is there in the question? I think that's all, right? No other things we saw. Okay. So balance sheet total should match. I think it's matching. Because no other current assets is there. Okay. Now, sir, why do we show minority interest? 1 second, sir. Sir, assets and liability, what did you do? You added only 80%, 90% or 100%. You took 100% of asset of holding company, 100% of assets of subsidiary company, you added them. Correct? Huh? For all assets and liability, you did this 100% addition you're doing. But does holding company have 100% control in subsidiary company or only 80%? Only 80%. That means we should have added only 80%, no? But we added how much percentage? 100%. Why is that? Sir, does holding company have a control in subsidiary company? Yes. When do you get control? If you own more than 50% shares in one company, you get the control. I used to give the same example in class. Let's say the machinery, subsidiary company has one plant and machinery. They are planning to use that machinery every day for 10 hours. Okay. Will holding company tell the subsidiary company, I have 80% control in you, macha. So first 8 hours, I will tell you how to use the machinery. Next 2 hours, you decide the way you want to use it. Does it work like this, or holding company only has full control? Just because holding company has 80% in subsidiary company does not mean they only control 80% of assets and liability. With control, you will be able to control 100% of assets and liabilities. So entire usage of plant and machinery, when you need to buy, when you need to replace, who should operate it, when the subsidiary company should expand, from where they need to buy, etc., etc. All this decision of subsidiary company will be taken by whom now? Holding company. That means holding company has small control or full control? Full control. Since they have full control, 100% of assets and liability we add. Though we have only 80% shares, with 80% you get full control over assets and liability. That's the reason we add 100% assets and liability, we add to the extent of 100%. But by chance, if subsidiary company goes into liquidation, subsidiary company liquidates, if it shuts down. Now let's say subsidiary company first will pay the outsiders, like bank people, debenture holders, creditors, first all they will get the money. After paying all them, still 100 rupees is remaining with subsidiary company. After paying off all of them, how much money is still remaining? 100 rupees. Entire 100 rupees holding company or subsidiary company will give to holding company. No. Whatever money is remaining, only 80% of this will belong to holding company. Balance 20% you have to give to other shareholders. That only we're calling it as minority interest. So since you are showing 100% of assets, does 100% of, you may be showing 100% asset, but does 100% of assets belongs to holding company or only 80%? 80%. That's the reason 20% ka entitlement you show in the liability side as minority interest. On the asset side, you're showing 100%. On the liability side, you're showing minority interest for 20%. So on the asset side, you're showing 100% asset. On the liability side, you're showing minority interest for 20%. So what is the net effect? 80%. Holding company has how much control in subsidiary company? 80%. This way that will be achieved. Hence, minority interest also will come in consolidated balance sheet. Is that okay? And assets and liability will be added to 100% extent. This is your one question on walkthrough of consolidated balance sheet. If it comes, it will be for minimum 14 to 16 marks. Sometimes you may be straight away for 20 marks. Previous attempt, now we'll have to see how it's going to work, because the pattern has changed. Okay, we'll see. So overall comfortable now? So if you're comfortable with this, some theory pointers, whatever I've written in chart, we'll run through again. Because whatever we have done now only, I'm expressing it in pointers. So I wanted to give you an idea about what and all we have done. Okay, so just give me a quick walkthrough, sir. Let me see. Because if you have understood this, consolidated balance sheet is done. That's all. Okay, but more or less this chapter only is done, because this is one of the popular questions from this chapter. Okay, so what is it? What did we do? What is the working note? Tell me again. Working note number 1 is shareholding percentage of subsidiary company. In basically in subsidiary company, who are the shareholders? That's one. Second one, working note of general reserve. And the working note number 3 is for P&L account of subsidiary company. Working note number 4, analysis of reserves and surplus of subsidiary company. So in this working note, what all will happen? All the reserves and surplus of subsidiary company will be allocated or distributed to whom? The shareholders. Who are the shareholders of subsidiary company? Holding company and minority interest. Allocation will be done in their respective shareholding percentage. But before you allocate, you have to split the reserves between pre and post. Pre-acquisition profit means those profits which were made by the subsidiary company before holding company became the shareholder. Those reserves and surplus which came after holding company became shareholder, we call it as post-acquisition reserves and surplus or post-acquisition profits. Okay, now do the segregation. Why is this segregation necessary? Because logically, should a pre-acquisition profit holding company get? No. Practically, are they entitled to get? Yes. So this pre-acquisition profit, will you transfer to your normal P&L? No. You'll adjust it with cost of investment. That's the reason we need to split the reserve between pre and post. So working note number 5, we do it for minority interest. Minority interest is a shareholder. They only ask for 3 things. In fact, 2 things: capital and reserves and surplus. But now reserves and surplus is already split as pre and post. So they will ask for 3 components. What are those? Their share of share capital, their share of pre-acquisition profit, their share of pre-acquisition, rather post-acquisition profit. Sir, if it is pre-acquisition profit, you will add. Post-acquisition profit, you will add. Suppose if it is post-acquisition loss, means deduct. We have not seen any problems in ICA study material like that, but I have discussed in class. It may be a post-acquisition loss also. Profit means add, loss means reduce. Okay. Then working note number 6 is your goodwill or capitalism. Goodwill here is also referred to as cost of control. How do you get goodwill or capitalism? Take the cost of investment. From that, reduce 2 things. One is the pre-acquisition profit, pre-acquisition reserves and surplus. Then pre-acquisition dividend. You will get the net cost of investment. Compare it with the share capital. Total share capital or only holding company share? Holding company share of share capital you compare. If you're paid more, or if you're getting a positive number, goodwill, negative number, capital reserve. Then the last working note is consolidated reserves and surplus. So you prepare one working note where you'll get the total reserves and surplus, which you can directly show it in consolidated balance sheet. First, show all the reserves and surplus of which company? Only holding company, like general reserve, CRR, DRR, etc., and do not also forget capital reserve. Then take holding company ka P&L and do some adjustment. What is the first adjustment? Add post-acquisition profit of subsidiary company. And then if you have any pre-acquisition dividend, reduce it. Why we need to reduce? Because that should have been reduced from cost of investment. But by mistake, our accountant transferred this as a normal dividend and transferred this income to P&L. So P&L has unnecessarily increased. Hence, we reduce it. So that is one. And if there is any stock reserve adjustment, stock reserve made by whom to whom? Holding company to subsidiary company. So since holding company has made this profit, holding company ka P&L has increased. So which you need to reduce it. That's all. Okay, sir. And whenever you're preparing consolidated balance sheet, the simple fund has only share capital of holding company will come. Reserves and surplus, should you have to worry, or we already have a working note? Working note number 7 is there, directly take from that. Okay. So then do not forget to show minority interest as a separate category. First, you will show shareholders funds. Under shareholders funds, equity share capital, reserves and surplus. Next separate category is minority interest. Working note number 5. Then non-current liability. Now remaining components is your assets and liability. All assets and liability you add 100%. Take just 100% you add it. If there is any stock reserve, reduce it from inventory. Okay, and if there is any mutual owings, reduce it from the respective component. That respective component could be debtor, creditor, bill receivable, bills payable, loan given or loan taken, like that. And on fixed assets, do not forget the revaluation adjustment. If there is any revaluation gain, add it. If there is any revaluation loss, subtract it. So if you have revaluation gain, you'll get extra depreciation. Due to extra depreciation, asset value will reduce. So reduce extra depreciation. But if there is a reversal of depreciation, means asset value will increase. That's all as consolidated balance sheet. Okay, Nasaru. All right. Now can we go through the theory pointers I've written? Okay. So this I've already written. I think I'll not go through this. I think it's fine. Maybe this one I'll discuss. Sir, I just now told, no? If it is post-acquisition loss, what do you do? If minority interest, if there is pre-acquisition profit, you will add. Post-acquisition profit, you will add. If it is post-acquisition loss, means deducted. Let us say minority interest ka balance was 1 lakh. In the first year, minority interest ka balance is 1 lakh. Second year, no sir, subsidiary company made a huge loss. Okay, they made around 10 lakh loss. And subsidiary has 15% stake in subsidiary company. That means out of 10 lakh loss, what is minority share of loss? 1,50,000. What is minority interest ka balance? 1 lakh. Sir, this is profit or this is loss? Loss. Sir, post-acquisition profit you will add. Post-acquisition profit you will add. If it is post-acquisition loss, what do you do? Post-acquisition loss, what do you do? Deduct. So how much is a minority ka? Their share of post-acquisition loss? 1.5 lakh. So if you do this, what are you going to get? Minority interest balance becomes negative. What AS 21 says is either show minority interest as a positive balance or 0. Don't make minority interest balance as negative, because if minority interest balance has become negative, means they have debit balance, meaning you can't show it on the liability side, you will be forced to show it on the asset side. So what AS 21 says is don't make the minority interest balance negative. Either it should be positive or maximum it can become 0. So but here it is negatives, no sir. If minority interest ka balance by chance become negative, how much it has become negative? 50,000. This 50,000 ka loss or 50,000 ka minority loss will have to be taken up by holding company. This minority interest ka excess loss will have to be taken up by holding company. So that means minority interest balance will be restored to how much value? 0. So don't show minority interest as a negative balance. If it becomes negative, that negative balance will be absorbed by holding company. Sir, unfair, no sir. Yeah, it's consolidation adjustment. They're not really suffering losses. This is just a consolidation adjustment. Suppose in year 3, subsidiary company made a bumper profit of 50 lakhs. Holding company made a bumper, or rather subsidiary company made a bumper profit of 50 lakhs. What is minority ka share? 15%. I think 15 5 is 7.5. So minority share of loss of profit. Profit, how much? 7.5 lakh. Now will you give entire 7.5 lakh to minority interest? Last year when the loss was there, what did you tell Macha? This excess loss, give it to holding company. Now we got loss of profit. Now when you get profit, no, don't give entire profit to holding. Don't give entire profit to minority interest. How much loss you did not give last year? 50,000. First adjust that. That means minority interest will only get how much now? 7 lakh. Like this. So when they get excess loss, give that excess loss to holding company. Later on, when they get more profit, from whatever loss you gave, no, adjust it from profit. This will go. I think we have done one problem on this also. Okay, that only I'm trying to summarize here because I don't have so much time to cover every problem. In consolidation, more than 20 questions we have solved. Okay, I don't have time for everything. Yeah, so just discussing like this only. Hope it's good with you. Okay. Great. So this is done. All right. So deduct mutual owings. I think we're comfortable with this, no sir. Mutual owings and all, you need to reduce it from consolidated balance sheet. So whatever we did now only is what I've called out over here. Done. However, by chance, if subsidiary company has any preference share capital, I've not seen this in the latest question. Some old question where this used to be there. Possible that minority subsidiary company can also have a preference share capital. Correct? Sir, equity share capital of subsidiary company will not come. Because for subsidiary company, it is share capital. For holding company, it is an investment. So it will get nullified. But now we're not talking about equity share capital. We are talking about preference share capital of subsidiary company. Okay. So if subsidiary company has any preference share capital, is this held by parent or somebody else? Is this preference share capital is held by parent company or holding company or somebody else? Somebody else. If it is held by somebody else, whatever is the value of preference share capital, no, add it to minority. You prepare a working note number for minority interest. Add preference share capital to minority interest. So why can't we show preference share capital, sir? We can't show preference share capital in consolidated balance sheet because who's preparing consolidated balance sheet? Holding company. Whoever has the control will prepare consolidated financial statement. So this consolidated financial statement is group who's controlling? Parent. So if you show preference share capital in consolidated balance sheet, you know what it looks like? Holding company has issued a preference share capital. Has holding company issued preference share capital or subsidiary company? Subsidiary company. That's the reason this preference share capital issued by subsidiary company will not come in consolidated balance sheet. You will not cancel it also. Simply you will add it to minority interest working. If at all it is there. I've not seen this question in any of ICI study material question. I think about in 2018 or 19, one previous year paper or MTP question had this adjustment, I think, if my memory serves right. Long back. Okay. If at all they come, you know what to do now? Okay, that's all. Can I move on to the next? Okay. Steps I've already written. This is stock reserve. Stock reserve you already know. Stock reserve will come under two circumstances. One, when holding sells to subsidiary or subsidiary sells to holding. Sir, who controls whom? Holding controls subsidiary. That means who's big daddy? Holding company. Who comes under subsidiary company? Who comes under holding company? Subsidiary. That means if holding company sells goods to subsidiary company means we call this as a downstream sale. We call this as a downstream sale because holding company is at the top. He's the big daddy. Subsidiary company is under him. So if if the sales is coming from holding to subsidiary, the arrow will go down. Hence they refer it to as downstream sale. So sometimes in the problem, instead of telling holding company sold goods to subsidiary, they may say downstream sale is 50,000. So you must know the meaning of what is downstream sale. You know what does downstream sale mean now? Holding has sold goods to subsidiary company. So if it is other way around, placing is still same. Holding is at the top, subsidiary is at the bottom. Who's selling goods to whom now? Subsidiary is selling to holding. So arrow is going down or up? Up. So what do you think this will be called as? This will be called as upstream sale. Adjustment we already know. If it is downstream sale, what do you do? If it is downstream sale means holding company is sold. Correct? If holding company sold means who made the profit? Holding company. So what happened to holding company ka profit? Same or unnecessarily increased? Unnecessarily increased. So where will you capture this working note? In working note number 7. Correct? It could be other way around, means subsidiary has sold goods to holding company, means who made profit? Subsidiary made profit. Subsidiary ka profit where do we capture under? Working note number 4, analysis of profit of subsidiary company. Under both the working notes, working note number 7 and working note number 4, you deduct it because profit is unnecessarily increased, which we need to reduce. Now question is where you will reduce. That's all. Here under working note number 7, here under working note number 4. That's what is this case all about. Done now? Okay. Next. Thanks. Revaluation of fixed assets. Revaluation we just now did. So revaluation of fixed assets, when will it come or why will it come? Because subsidiary would have taken their fixed assets at book value. But are we considering book value for consolidation purpose or market value? Market value. That means compared to book value, market value can be more or it could be less. If it is more, you will get revaluation gain. What do you do for revaluation gain? Where will you show it under? Revaluation gain, where will you show? Just now we did. Revaluation gain, you will show it under pre-acquisition profits, under working note number 4. Revaluation gain, I'm not talking about depreciation, I'm talking about revaluation reserve. Revaluation gain, where will you show it under? Working note number 4, as negative or positive number? Positive number. Okay. However, if you get revaluation loss, means you will show under working note number 4 itself, but as a negative. That's what I've written here. This is negative, here it is increase. Done. But due to this revaluation gain, if you have revaluation gain, means you will get less depreciation or more depreciation. You will get more depreciation. That means you have to account more depreciation now. If you have to account more depreciation, means P&L balance will reduce. Which P&L? Post ka, a pre ka or post ka? Under post acquisition profit, you have to reduce the depreciation. Under post acquisition profit, same under working note number 4 only, but this will be under post. Post may you have to add or minus. Minus. Is that okay? Alright. However, if you get a revaluation loss, if you have revaluation loss, means will you get excess depreciation or you will get reversal of depreciation? Reversal. What do you do for reversal of depreciation? If it is reversal of depreciation, under working note number 4, under pre-column or post-column? Post-column mein, what you will do? Post-column mein, you will add back. That's what we did here. No? In the same problem, I've just expressed it in words. That's all. Done, Sarji? Okay. Can I move on to the next? Okay. Next is dividend declared by subsidiary company. Sir, if subsidiary company has declared the dividend, means what will happen to P&L balance of subsidiary company? It will reduce. That's common. Now, if subsidiary company has declared the dividend, means who will receive it? Parent and, or rather, when I use the word parent, don't get confused. Ind AS uses the term, CA final may we use it, we don't use holding company, we use the term parent. I've just come out of CA final marathon, so some of the terminology may come like that. Is that okay? Parent company, we call, in AS terminology, we call it as holding company. In Ind AS terminology or CA final terminology, maybe we call it as parent. That's okay. You write holding only, don't write parent. Okay. So if subsidiary company has declared dividend, means who will receive it? Holding company and minority interest. So this dividend received, now first you need to check whether it is a normal dividend or a pre-acquisition dividend. If it is pre-acquisition dividend, if you want it as formula, pre-acquisition dividend, reduce it from working note number 3, 4, 6, 7. If you don't want logic, okay, simply if there is pre-acquisition dividend, reduce it from working note number 3, 4, 6, 7. Why is 3, sir? Or you tell me, why we reduce it from working note number 3? First of all, what is working note number 3? P&L account of subsidiary company. Subsidiary company only declare the dividend, no? When you declare the dividend, what will happen to P&L balance? It will reduce. So hence, reduce it from working note number 3. Okay. Why do you reduce it from working note number 4? Because in working note number 4, are we distributing closing balance or component by component? Component by component. When you distribute, P&L balance will increase or P&L balance will reduce. If a component is increasing the balance, means we give it as a positive apportionment. If a component is reducing P&L balance, means negative apportionment. Like here, excess depreciation. Excess depreciation, you distribute it as a positive number or negative number? Negative number. Why? Because it was reducing P&L. So here also, due to dividend, P&L balance will reduce. Hence, this also you in working note number 4, you reduce it. Is that okay? Working note number 6. What is working note number 6? Goodwill. So under goodwill, what is the first component under this working note? Cost of investment. What should you do for pre-acquisition dividend? Reduce it from cost of investment. Hence, it has to be reduced from working note number 6. Okay. Working note number 7. What is working note number 7? Consolidated P&L or consolidated reserves and surplus. Our super duper accountant of holding company, he treated it as pre-acquisition dividend or he treated it as normal dividend. He accounted this as normal dividend and transferred to P&L. That means P&L of holding company is unnecessarily increased. Hence, to restore the balance, we will reduce it. Hence, if there is pre-acquisition dividend, reduce it from working note number 3, 4, 6 formula. Okay, G. Move on to the next one, G. However, if it is the normal dividend, what is the entry? You already know. Bank to dividend, dividend to P&L. That's what I've given. Now making sense? That's the reason I took one problem. So now only if you had taken this, I thought it would have not made sense is what I felt. So I took one question and coming back to this. So other things is intercompany eliminations that we already discussed now. Mutual owings and all you need to eliminate. Now, sir, till now we did a consolidated balance sheet. There is also consolidated P&L because the statement chapter name is Consolidated Financial Statement. So there is also consolidated P&L. Consolidated P&L, if it comes, no, big smile. Why? No dum only. Just take holding company ka income and expenses, take subsidiary company ka income and expense, go on adding taka in your calculator, go on doing, that's all. Simple addition. That's all, nothing else. But however, if there is any mutual owings, you need to reduce. So mutual owings means holding company has sold goods to subsidiary company. For holding company, it is a sales. For subsidiary company, it is a purchase. Eliminate because mutual owings. Holding company has given some service to subsidiary company and charging some money. Holding company has given, subsidiary company has some asset. That asset ka installation was done by holding company. And holding company is not doing it at free of cost. They charge 1 lakh rupees for installation. Complex asset. So installation charges how much? 1 lakh. Who gave installation charges? Holding company. And holding company is giving this at free of cost or charging money? Charging money. So think from holding company's perspective. This 1 lakh for holding company is an expense or income? Income. For subsidiary company, it is an expense. How much? Same 1 lakh. What are these? These are intercompany transaction. So from income also eliminate 1 lakh. From expense also you eliminate 1 lakh. That's all is the data here. Done. Okay. And also watch out if some problems where they will tell subsidiary company has given some bonus shares. If they give bonus shares, now working note number 1 becomes important because shareholding percentage may change. Okay, because maybe normally what they give is like normally in consolidated balance sheet, they'll give balance sheet. No, in balance sheet, you will say equity share capital. Let's say subsidiary ka equity share capital is 10 lakh. Okay, in the current year, subsidiary company has already given bonus. Subsidiary company has already given bonus. That means this equity share capital is before bonus or after bonus? This is after bonus. After considering bonus share capital has become, maybe I'll take it as 15 lakh. Okay, this is 15 lakh. Yes, sir. So, all right. But in the adjustment, they will say holding company has purchased, let's say 7 lakh shares. Holding company has purchased, or maybe I'll take it as a smaller number. Holding company has purchased 6 lakh shares of subsidiary company by a cost of, let's say, 25 lakh rupees. Assumption. Okay. So in some problems, shareholding percentage directly they'll give. In the 1V problem, we did 80% straight away was given. Some problems we have to calculate. Is that okay? And they will tell in the problem, bonus was given in the ratio of 2:1 or maybe 1:2. Bonus of 1:2, meaning if you have, or whichever way, what it means is don't be misled by the word ratio here. What it means is if you have 2 shares, you will get 1 bonus. If you have 2 shares, you will get 1 as bonus. Okay, sometimes they'll give it as 1:2, sometimes they'll say it as 2:1. Don't misread the ratio. Bonus ka number will always be lesser. Whichever they give, what it really means is if you have 2 shares, you will get only 1 as bonus shares. Now, sir, can you tell me the shareholding percentage? H Limited ka shareholding percentage in this problem. Actually, make this as 1 second. 60,000 shares. And each share ka face value is 10. Okay, in the interest of time, I'll only do it. Okay, so how do you get shareholding percentage? Compare out of the total shares, how much shares is held by holding company. So what is the share capital of subsidiary company in totality? 15 lakh. Each share ka face value how much? 10. That means totally how many shares does subsidiary company have? 1,50,000. Okay, in this 150, how much is held by holding company? 60,000. So in this 150, 60 is held by holding company. Means what is the shareholding percentage? 60 divided by 50 is how much, sir? Into 100 if you do, you're getting how much? 40%. Correct? Wrong calculation. Wrong calculation. Why, sir? Sir, this 1,50,000 is after bonus. But the 60,000 shares holding company purchased. Holding company purchased. Bonus shares can you purchase or it is received at free of cost? That means this 60,000 is before bonus. So when you are doing a ratio analysis, numerator denominator analysis, both the numerator should be either after bonus or both numerator and denominator should be before bonus. Only then you will get the correct shareholding percentage. Here one number is after bonus, another number is before bonus. That means it is absolutely wrong. Yes, no? So you have to bring both the things to before one. How? Just check over here. After bonus, how much it has become? 15 lakh. And bonus is given in what ratio? 2:1. That means indirectly what they're trying. 15 lakh you distributed in this ratio. How much are you getting? This is 10 lakh. Okay. And 15 lakh into 1/3 you do. What are you getting? 5 lakh. Indirectly what they're trying is before bonus, the share capital of subsidiary company was 10 lakh. How much bonus you gave? 5 lakh. So total has become how much? Total has become 15 lakh. Like this. Is that okay? So now, what is each share ka face value of holding company? 10. So how many shares does subsidiary company have? 1 lakh. In that 1 lakh, holding company owns 60%. Now, if you do 60,000 divided by 1 lakh into 100, you're going to get 60%. Because the 16 lakh, 60,000 is also before bonus. This 1 lakh is also before bonus. For you to get shareholding percentage, either both the number has to be before bonus or both the number has to be after bonus. Whether you calculate before number bonus wala number or after bonus, I proved it to you in the regular class. Both will give you the same answer. Okay. Whether you take before bonus or after bonus, answer will be the same. Because only you are getting bonus or even minority interest is also getting bonus. Minority interest also is getting that. So bonus shares will not affect your shareholding percentage. Before bonus, if H Limited has 60% control, after bonus also they will have 60% control. Because only holding company will not get bonus. Even minority interest also will get the bonus. But the point here is when you're calculating, both the number has to be either in the numerator also has to be before bonus, denominator also should be before bonus, or numerator also should be after bonus, denominator also should be after bonus. So here one number was before, one number was after. That is wrong. Okay. So that's the reason I split it up. I think hope you got this ratio. Why did I take 2/3? Because bonus was given in the ratio of 2:1 now. So if you have 2 shares, you're getting 1 as bonus. So whatever was the share capital of subsidiary company was how much? 15 lakh. I distributed in 2:1 ratio, which you're going to get it as how much? 10 lakh, and after bonus it has become how much? 15 lakh. That means how many bonus shares have you given? 5 lakh. Indirect adjustment. If you want, you can retrace it also. For 2 shares, how many bonus? 1. For 10 lakh worth of share, how many bonus? If you have a 2 means you will get 1 as bonus shares. For 10 lakh worth of old shares, how many bonus shares ka worth you will give? If you calculate this, how much are you getting? 10 lakh into 1/2, which is how much? 5 lakh. How much have you written as bonus? 5 lakh. It is free tracing like this. Okay. So share capital of subsidiary company was 10 lakh before bonus. They gave bonus. This is not number of shares. This is the worth. The worth of bonus shares given is 5 lakh and the total has become 15 lakh. Now I'll take both the number on the before ka platform and find it out. This also we have done a couple of questions in our regular class on this. Okay. So I'm just running through this adjustment. So watch out for these sort of adjustments also. Okay, G? Yeah. All right. 1 second. I think 1 or 2 more questions I will do, sir. All right, sir. Till now, you used to get goodwill in one format. Can you tell me that format once again for me? First, to take cost of investment, reduce pre-acquisition profit, reduce pre-acquisition dividend, reduce face value of share capital, holding company share of share capital. Then you used to get goodwill or capital reserve depending on whether it is a positive or a negative number. Okay. There is another way to arrive at the same number. Okay. That we have done in amalgamation. Can you tell me how did you do an amalgamation, sir? How did you calculate goodwill and amalgamation? You calculated PC with the net assets. Correct? You calculated PC with net assets. That is also same. Till now we are also doing that only. This is just like another format. I'll just prove it to you. Okay, let's take this. I've proved it to you in class also. Now in the interest of just for a new audience, I'll just prove it to you here once. X acquired 90% shares in Y Limited. X Limited is the holding company, Y Limited is the subsidiary company. And which day have they acquired the shares? 31st March 2024. On the last day of the year, they acquired the shares. Any day they can acquire, no? So here I've assumed that as what day? Last day of the current year, the shares have been acquired. I've given the balance sheet of on 31st March 2024 of subsidiary company, which is Y Limited. Some numbers are randomly I've assumed. Okay, any number you can take, answer will not change. These numbers I've taken. Okay, Nasaru? Alright. Sir, let's calculate goodwill or capital reserve as per the method we have just now applied. Okay, first you will take what, sir? Cost of investment. How much is the cost of investment? I think cost of investment will, I think here I have to give it. I think I've taken it as for 12 lakh rupees. Okay, cost, they purchased 90% shares in Y Limited for 12 lakh rupees assumption. So how do you get goodwill again? For what is the first component? Cost of investment, 12 lakh taken up. Okay, then you reduce what, sir? Pre-acquisition. There's no pre-acquisition dividend. Eliminate that. Okay, because every problem is there has to be dividend declared or not required. Not required. Okay, if it is there, bring it in. Otherwise, leave it. It's fine. Okay, if dividend is not there, what is the next adjustment? Pre-acquisition profits or is it profit or pre-acquisition reserves and surplus? Pre-acquisition reserves and surplus you need to reduce. Entire pre-acquisition reserves and surplus or only holding company ka? Holding company ka. Sir, which day you got the control? Last day. Last day ka balance sheet, do you know? Yes. On the last day, how much was reserves and surplus? 2 lakh. This 2 lakh came after holding company became shareholder or much before? Before holding company became shareholder, only all this reserve was already there. Correct? No, because holding company acquired the shares on the last day. On the day they acquired, reserves and surplus is already existing. That means what sort of reserve is this? Pre-acquisition reserves and surplus. Agreed, sir? Any problem? No. Sir, normally you prepare general reserve and P&L account. You prepare working note number 2, general reserve. Working note number 3, P&L. Why? Because we want to know among in the P&L means there will be one component or many components. Many components. In that component, how much is pre, how much is post? We want to know. That's the reason we prepare that working note number 2, 3 and all. Here, do we have that drama or pre and post? We clearly know. We clearly know because there is only one reserve and surplus, which is 2 lakh and all, and you got the control on the last day. So this 2 lakh was already existing. That means entire 2 lakh is what? Pre-acquisition profit. So should I have to prepare general reserve, P&L, ledger and all, or not required? Not required because straight away you know the number. Okay, so how much is pre-acquisition profit? 2 lakh. Will holding company get entire pre-acquisition profit or their share? Their share. How much is their share? 90%. So calculate 2 lakh and 90%. How much is that? 1 lakh 80,000. Correct? This method. 1 lakh 80,000. Yes, sir. And then we used to do what? Reduce share capital. Entire share capital or only holding company ka share? What is the share capital of subsidiary company? 10 lakh. What is holding company ka share? 90%. So 10 lakh and 90% you do. How much are you getting? 9 lakh. So if you do this, you're getting a positive number, which is only we used to call it as goodwill. Yes, Saru. Any problem? No. Okay. There is an other method. What is that is? Sir, if you own equity shares of another company, you have a right over assets or you have a right over net assets. If you have equity, if you own equity shares of one company, you have a right over assets or net assets? Net assets. Sir, if let's say a company, subsidiary, one company has a land and building. If you own equity shares, that land and building straight away will not be given to you. If company shuts down, what will that company do? They will sell land and building. And after selling, they will not give the money to equity shareholders first. They will give it to creditors, bank loan people, debenture holders. Everybody will be settled first. After everybody is settled, whatever asset remains, that will be given to equity shareholders. So equity shareholders don't have a right over assets of the company. They have a right over net assets. Is that okay? That's what is a definition of equity. If you look at the definition of equity, equity is an instrument that gives the holder the right over the assets of the company after deducting all the liabilities. Or equity is that instrument which gives the holder the right over net assets of the company, we say. Okay, now sir, can you tell me how much is net assets of subsidiary company? Calculate, sir. How much is net assets of subsidiary company? How do you calculate net assets of subsidiary company? We have to take book value or revalued amount. Revalued amount. Here, do we have any revalued amount or no? Nothing. No. That means book value itself, book value and revalued amount, we assume it as same. So calculate net assets for me. How do you get? Adding all the assets, we get 15 lakh minus full you deduct or only outside liabilities? Outside liability. Which is outside liability? Current liability, which is 3 lakh here. So how much will be net assets, sir? 12 lakh. This 12 lakh is a net assets of which company? Subsidiary company. Entire net assets of subsidiary company belongs to parent or only their share? Their share. What is holding company ka share? 90%. Total net asset is 12 lakh. Parent or holding company will only get their share. So 12 lakh and 90% is how much? 10 lakh 80,000. Agreed? Normally in amalgamation, how do you calculate goodwill? Tell me again. PC used to compare with net assets. This PC only here we calling it as cost of investment. Correct, no sir? Okay. There used to compare PC with net assets fully. PC used to compare with net assets fully. Here are we comparing it fully or 90%? 90%. Why, sir? Sir, in all amalgamation problems, no, we acquire. They used to say A limited absorbed B limited. X limited acquired Y limited. When they say acquired, it is 50%, 60% acquisition or 100%. 100%. That means in all our amalgamation problem, PC was for 100%. Here, have you acquired 100% or only 90%? So in that problem, since it was 100% acquisition, PC was for 100%. So net asset also you compare it with the 100%. Here, net asset is for 100%, but PC is for 100%. No, you acquired control only to the extent of 90%. 90% PC, can you compare it with 100% of assets and goodwill, sir? Is that right comparison, or they have to be on same platform? Same platform. So if PC is for 90%, means net asset also should be for 90%. That's the reason we take net asset ka 90%. Okay, Nasaru? So how much is 90% of net assets? 10,80,000. How much is PC? 12 lakh. How much are you getting? 1,20,000. What are you getting? Goodwill. How much did you get over here? Goodwill. That means indirectly till now you are doing amalgamation only. You are doing amalgamation. Goodwill that you calculate is not as per consolidated financial statement. The goodwill that you calculate is as per AS 14. The goodwill that you calculate is as per AS 14. Sir, yes sir. In your syllabus, AS 14 deals only with 100% acquisition. In your CA intermediate syllabus, AS 14 deals only with 100% acquisition, meaning A Limited absorbed 100% in B Limited. X Limited acquired 100% of Y Limited. But to get control, do you want 100% or more than 50% is good enough? More than 50% is also amalgamation. If A Limited absorbs 60% of B Limited, it is also amalgamation, just that it is not there in your syllabus. CA final in days 103 you'll learn. Is that okay? So whatever goodwill that you are calculating, is same only. Because goodwill calculation is not as per AS 21, it is as per AS 14. Steps are same. So I mean this and this are same, sir. Yeah, sir. See, sir. Proved it to you, sir. Simple logic. I told you in amalgamation there, net asset ka another name is capital employed. Another name is shareholders funds. There are two ways in which you can calculate net assets. Asset minus outside liabilities or shareholders funds. Here what are you doing? Check. You're taking share capital. You're taking pre-acquisition profit. Pre-acquisition profit means on the date of control, how much reserve and surplus was there. Share capital and reserves and surplus only you call it as capital employed. That is only nothing but your net assets. Till now you are doing that only. Just fancy name. So that means we can do like that. No, sir, it is easy, no, sir. Now, normally in consolidation problem, they'll give you a lot of adjustment like bonus, dividend, this and that. So it's easy to work in that structure, format structure I've given to you. When you work it out from your normal method, it may be a little confusing for you. So in bigger problems, always work out the pattern. 7 working outs we showed, do it in that way only. When they give you smaller questions, then you can use shortcut method like this. We may not bother about this. We'll directly use this. Is that okay with you? Oh, what is this now? What is the new shortcut method? Just compare cost of investment with net assets or holding company share of net assets. Just compare PC or cost of investment with holding company share of net assets. Accordingly, you will get goodwill or capital reserve. Okay. Some problems may you have to do this because they will only give asset ka information and liability ka information. Share capital and reserves and surplus will not be given at all. If share capital and reserves and surplus information, if it is not given, can you apply this method or not possible? For you to apply this method, reserves and surplus and share capital should be compulsorily given. If it is not given, then you have to apply previous method only. Welcome to the next question. That's what we have to do in the next. Understood? Okay. RTP May 2024, man, this question was asked. Can we run through this question? New method, you know, no? Just for my satisfaction, tell once. Just to take cost of investment. Compare it with total net assets? No. Only holding company share of net assets. That's all. So what about pre-acquisition dividend? Sir, pre-acquisition dividend is AS 21 concept or AS 13 concept? AS 13 concept. What does accounting standard 13 say? Pre-acquisition dividend should be reduced from cost of investment. So whether you are working from method number 1 or method number 2, pre-acquisition dividend should be compulsorily reduced from cost of investment. Is that okay? That is just an add-on. So whichever method you follow, pre-acquisition dividend compulsorily will be deducted from cost. So it doesn't vary based on method because it is not AS 21 adjustment. It is accounted as per AS 30. That is the reason. Now can we run through this? All this, whatever I'm saying now, ditto will come in question number 70. Ideally, I should not even solve this question. But still 5 minutes I will solve. Okay. Zoom acquired 70% of Star. Sir, with 70% do you get control? Yeah. Alright. At what price, sir? 30 per share. Following is extract of balance sheet of Star. 15 lakh equity shares of 10 each, which is 1 crore 50 lakh. And they have given balance sheet of which company, sir? Star. Subsidiary. Basically here Zoom is the holding company, Star is the subsidiary company. They also have debentures, they have plant and PP and all they've given. Okay. On the same day, Star declared a dividend of 20%. 1 second, sir. Zoom Limited acquired the shares. On the day they became shareholder, that day only they got dividend. On that day only they got a subsidiary company declared a dividend. Sir, they will declare dividend out of the profit existing. They will declare, subsidiary company will declare the dividend out of profit existing. So today holding company became shareholder. Today's profit only is utilized to pay dividend. So today's profit is post-acquisition profit or pre-acquisition profit. The day holding company became shareholder, subsidiary company already has profit, mean that profit only we call it as pre-acquisition profit. Any dividend paid out of pre-acquisition profit is what dividend? Pre-acquisition dividend. I mean, they will not tell in every problem this is pre-acquisition dividend. You need to figure it out. Today holding company got control and today only subsidiary company declared shares, means obviously this is what sort of dividend? Pre-acquisition dividend. And pre-acquisition dividend has to be compulsorily reduced from cost of investment. Okay. All. And was agreed between both companies. PP were to be depreciated at 10%. Investment was to be taken over at market value. Revaluation adjustments. Okay. Yes, because now whenever you're finding net assets, we already did in purchase method. Net assets, you will find it at book value or agreed value. Agreed value. So you will take what now? We'll take book value or agreed value? Agreed value. Is that okay? Calculate goodwill or capital reserve. Now we'll use shortcut method. Is that fine with you? Okay. Now what we will do. So tell me, sir. First, one working note we need for pre-acquisition dividend. I think why do we have to solve? We'll quickly run through. Pre-acquisition dividend. How much dividend is declared, sir? 20%. First of all, how much is the share capital or how many shares does subsidiary company have? 15 lakh. How much did parent acquire or holding company acquire? 70%. Subsidiary company has 15 lakh shares. In this 15 lakh shares, 70% is acquired by holding company. So that means the number of shares is 10 lakh 50,000. Any doubt? No. Okay. What is the face value of each share of subsidiary company? 10 rupees. How much dividend is declared? 20%. So can you tell me what is the dividend per share? DPS? 10 rupees is the face value. You can, so normally you multiply dividend on the total share capital. No. If you multiply on the total, you will get total dividend. If you multiply on each face value, you will get dividend per share. One share ka face value is 10 rupees. They have declared the dividend at 20%, means on one share, how much dividend you will get? 2 rupees. How many shares does holding company own? 10.5 lakh. So total dividend received by Zoom, that is the holding company, how much? On one share, 2 rupees. 10.5 lakh shares, how much? Quickly I'm solving. They've put up the solution. Okay. So I'm quickly running. Is that okay with you? This is 21 lakh. What sort of dividend is this? Post or pre? Pre-acquisition dividend. What should we do for pre-acquisition dividend? Doesn't matter which method you follow. Pre-acquisition dividend should be compulsorily reduced from cost of investment. So can we calculate goodwill now? So how do you calculate goodwill now under the revised shortcut method, sir? First you will take PC. PC is nothing but cost of investment. We have to calculate or given? At 30 per share. Okay, they have also given. One share we paid how much? 30. How many shares have we acquired? 10 lakh 50,000. So 10.5 lakh shares we have acquired on one share 30 rupees. How much is this, sir? Don't want to tell. 10.5 into 30. That is what, sir? 3 crore 315 lakh, can I write? 3 crore 15 lakh, which is nothing but 315 lakhs. Okay. Then what, sir? Immediately you will compare it with net assets? No. Reduce pre-acquisition dividend. How much is pre-acquisition dividend? 21 lakhs. Okay. Then you will get the net cost of investment. So what is the net cost of investment? In fact, you don't have to do this, but it's fine. How much is that? 294 lakh. That means your cost of investment is only 294. Compare this with what? Net assets. Total net asset or your share of net assets? Your share of net assets. Now for net assets, we need to put up a separate working note. First, we will put up that working note and come back to this. So how do you get net assets? Book value or agreed value? Or take your calculator. It's okay. We'll do it from this. 1 minute. First, debenture. Have they told? First, we'll start from assets. We have PP. PP was taken over at same value or they told less 10%? They show it has to be depreciated at 10%, means we have to taken it at less 10%. So 105 lakhs it is, minus 10% is how much, sir? 94.5 lakhs. Investment, what did they say? Investment has to be taken over at market value of 90 lakhs. Adjustment they have given. Current assets, have they told anything? No. 102 lakhs. Loans and advance. Sir, loans and advance is coming under current assets. So this is not loans and advance taken. This is loans and advance given, meaning it's an asset. So 33 lakh. If you add all this, what are you going to get? Total assets. We want total assets or we want net assets? So to get net assets, what do? Reduce all the outside liability. Will it reduce share capital? No. Only debenture. How much is debenture? Have they told any agreed value? No. If they don't give agreed value, book value and agreed value, we assume it as same. So this is 15 lakh. And trade payable also, we assume it as 82.5. Reduce this. How much is your net assets? Triple two. 2 lakhs. Okay. Triple 2 lakhs is your net assets. Correct? Sir, you paid 294, but net asset is only worth how much? Worth is 222, but you paid 294. That means you're paying more. How much more you paid? 72 lakhs. That means what is that? Goodwill. Okay. Huh? Hey, some calculation went wrong, kada? Here they're saying something more. 294 they're saying. This is right. Net asset they're saying it is wrong, kada? This is 294. We got 294 only, no? Yeah, this is right. Net asset, I think they are saying wrong. It's not 222. They are saying it is 1 crore 55 lakh 40,000. PP 105 we took. Investment 90. Current assets this much. Loans in advance. I think your calculation mistake you have done today. Do it again. 222. Oh, hey, actually, 1 second. Hey, no, correct. Sir, we took 222 lakhs. Mistake. Why? Sir, 222 lakh is total net assets. We own total net assets or we own only 70%? We own only 70%. So we can't take total net assets. We have to take only our share of net assets. So 222 into 70%. How much is that, sir? Correct. My bad. So how much is this, sir? 155.4. So 294 minus 154.4. If you do, how much are you getting? Something. 138 point. 138.6 lakh. Okay, so that's what they're calling it as 1 crore 38 lakh 60,000 is your goodwill. Okay, do not forget, yeah, this could happen as a common mistake. Okay, don't take total net assets because probably again, muscle memory. We told our share of net assets, but we take total net assets because we have done so many questions in amalgamation. In amalgamation, we never multiply percentage. We just directly compare with net assets. Okay, so happens. Is this a conscious mistake? No. In my mind, I know that we should only take our share of net assets, but my hand wrote 222. So these sort of things happen. Okay, because you can only develop this. Now you have to remind yourself that this mistake should not be done. Like this, what and all mistakes you are doing, write it down in a small piece of paper. Maintain like 2 or 3 sheets of paper. These mistakes, write it down. So that on your examination, no need to do. Here we can do whatever mistakes you want. It doesn't matter. Correct? But on the examination day, these sort of mistakes should not happen. Because this mistake means 2 marks gone. Simple mistake, but 2 marks gone. Okay. From 40, our marks became 38. From 200, our aggregate became 198. We don't want to land up in that scenario. Okay. So these sort of small things only kind of will ultimately help us to become chartered accountants. Okay. So you have to identify this. I'm not saying this mistake you will only do. Like this, you may make another mistakes of your own. Identify, write it down. Don't be a lazy. Okay, you can only grow when you learn from your mistakes. Don't be scared to spell out your mistakes. Okay, it's all right. Okay, everybody, even like as a teacher, even first batch when I started, I would have done 101 mistakes. If you think I've become better teacher now, that's because only I've identified what I should not do. Now I will also remind myself next time when you're teaching, dabba fellow, don't do this, or else naach ke mana maryade will go. Yeah, now I'll remind myself of that, like that. Okay, this way I will not commit it in the next batch. Like that, you should also remind yourself that whatever mistakes you are doing, note it down and don't commit it on the paper. That's the reason we say write some mock papers so that these sort of mistakes you can identify. Dana sir, now can I move on? And people are laughing. Okay. Time up. Okay, sir, one question in MTP they have given. Okay, that is there in study material also. Virat and Anushka wala problem. Okay, name only is fancy. Nothing is fancy in the problem. Not even one adjustment is there, sir. Here, check. Balance sheet information they have given. Virat acquires 80% equity shares in Anushka since Anushka's incorporation. The day Anushka company was incorporated, from that day only Virat is line modifying. Okay, from that day only Virat has already acquired shares. That means every profit which Anushka Limited has made has come after Virat has become shareholder. That means every profit is what? Post-acquisition profit. That means if you don't have drama around the post-acquisition profit means, should we have to prepare general reserve working note? Not required. P&L? No. Analysis of profits also, entire pre-acquisition profit gone. Only component that will come is in the post-acquisition profit. So whole working note just for one adjustment. Okay. Then put the data under working note number 567. Very straightforward question. It's come in MTP, and I hope and I pray that it will come in your exam also. Yeah, nothing, literally nothing adjustment. See, everywhere 0. The whole working note is 0, sir. First working note they only gave. Virat acquired 80%. So first working note, nothing. Second working note, third working note, not required because every reserve in surplus is post-acquisition. So how much reserve in surplus Anushka Limited has? What is reserves in surplus of Anushka? 1 lakh. Entire 1 lakh is post-acquisition profit. So put entire 1 lakh under post-acquisition profit and distribute in 80-20 ratio. Working note number 4 gone. Working note number 4 gone means working note number 567 is very simple. Minority interest will ask for their share of capital, their share of pre-nothing, their share of post-20 over. Goodwill working note. Done. Consolidated P&L. That also there is nothing else. There is no stock reserve, there is no pre-acquisition dividend, nothing. Okay. So that is this particular problem. Yes, sir. So can you manage? Yeah, that is what is given in MTP, but we have solved this in regular class. It is there in same question is there in study material also. We have done it in our regular class. Just say. Okay. And this one more question I'll quickly discuss. Maybe one component I'll discuss and move on to the next one. So from the following data, excuse me. Now it is no more 200. Now it's become 150. Only 3 papers, no? So aggregate is 150. Correct? Okay. You told 200, sir. One more mistake, sir. Okay, okay. From the following data, determine in each case. All are different cases. Minority interest you need to find out on the date of acquisition. Meaning date of acquisition means date of control. And on the date of consolidation. So you need, till now we used to find out minority interest only for the date of consolidation. Now they are asking for the date of control and date of consolidation. Same problem is there in study material also. We have done it, just quickly revising it. They have given this data. They have given 4 cases. Each case is separate. A owns 90%. A is the holding company. If A owns 90% means minority interest will own 10%. Simple, sir. These sort of problems don't use old method. Old method means 7 working notes. Don't use that. Use a shortcut method. What is a shortcut method? To get goodwill, what do you simply do? Cost of investment, you compare it with total net asset or your share of net assets. Your share of net assets. Yes, sir. And minority interest is also a shareholder. What does a shareholder, if you are a equity shareholder in one company, what are your entitlement? Net assets. Either you can say share capital, pre-acquisition profit, post-acquisition profit. For that, we need to find how much is pre, how much is post. We don't want all that drama. If you are an equity shareholder, what you are entitled to get is a net assets. How do you get net assets? Asset minus outside liability, one way. Or share capital plus reserves in surplus existing on the date of control. Whatever reserves in surplus existing on the date of control only we call it as pre-acquisition reserve in surplus. Yes, no. So simply take share capital, add reserves in surplus existing, you will get net assets. Of the net assets, minority interest will get their share. Check in the first case. How much does minority interest own? 10. Parent owns, holding company owns 90% means minority interest will own 10%. Sir, what is the date of acquisition? 1st January. On 1st January, how much was share capital? 1 lakh. How much was P&L? 50,000. Now, should we have to find out net assets using asset liability approach here or shareholders funds? Shareholders funds. What is the shareholders funds on 1st January? 1 lakh 50,000. That is nothing but net assets. So total net asset of subsidiary company is 150. Minority interest will ask for their share. What is their share? 10%. So what is minority ka share, sir? 15,000. So on the date of control, minority ka balance is 15,000. Got it? Huh? Same data you have to find out on the date of reporting also. Date of reporting means date of consolidation. Yes, no, sir. Date of when will you prepare consolidated financial statement? On the date of control or at the year end? The year end, what is minority interest ka balance? They're saying. Same thing. On the date of control, if you want minority interest, you need to find out net assets on the date of control. If you want minority interest on the date of consolidation, then on the date of consolidation, that is at the year end, you have to again find net assets. How can you find net assets? Same, share capital and reserve in surplus. On the consolidation, date is 31st December. On the consolidation date, share capital and reserve in surplus put together was 170. So on the date of consolidation, or can I call it as DOR? DOR as in date of reporting. You prepare consolidation or you report consolidated financial statement only at year end. So that I'm calling it as DOR. DOC stands for date of control. DOR stands for date of reporting. So on the date of reporting, that is on consolidation date, how much was the net assets? 1,70,000. How much minority interest entitlement is? 10%. That means minority interest will be 17,000. That's all. Like this, they've given 4 cases. Can you manage? Is that okay? I'm just revising. Is that okay? I don't have to do everything, no? 4 different cases they've given. That's it. Okay. This is for minority interest. Next, they're asking you to calculate goodwill or capital reserve for each scenario. How do you get goodwill or capital reserve? New method. Cost of investment with your share of net assets. Sir, goodwill you will get at the end of the year on the day you get control. When you get confused, always think you calculate goodwill as per consolidation standard or amalgamation standard. Amalgamation standard. When will you apply amalgamation standard? When the moment you get control. On the day you get control, you have to. Sir, what is the difference between AS14 and AS21, sir? Sir, AS14 is applied once when you get control. When you get control, no, you have to apply amalgamation standard and get goodwill or capital reserve. Consolidation, no, sir, is you prepare consolidated financial statement. Financial statement, you prepare it once or every year. So at the year end, no, you have to go on preparing consolidated financial statements. So how long, sir? For how many ever years you have control, for that many ever years, you need to prepare CFS. If you have control for 10 years, that means for 10 years, you need to prepare consolidated financial statement. So after that, if you lose control, meaning if you sell subsidiary ka shares, then you lose control. In that case, you don't have to prepare consolidated financial statement. In that case, what do we do, sir? There is something called loss of control accounting. You will study in Ind AS 110 in CA Final. Not here. Okay. What we'll do, whatever is required for your syllabus, not too much. Fine, sir? Alright. So basically, AS14 is one-time activity, but accounting standard 21 is one-time activity or recurring activity. Recurring activity. So as long till you have control, you'll go on preparing CFS, like that. Okay, this is the difference. Now coming back to goodwill. Goodwill, you'll calculate it on the date of control, date of reporting, which date? Date of control. Okay. So that means to calculate goodwill, we take what, sir? The date of control. So on the date of control, check how much is the net assets. In first case, maybe we'll calculate here. What is the net assets on the date of control? How do you get net assets? Same, share capital and reserve and surplus. So what is the net assets? 1,50,000. Correct? That is total. You can call it as total equity. You can call it as shareholders funds, or you can simply call it as net assets. Entire net assets, can you compare with your cost of investment or your share? Your share. What does parent own in first case? Holding company owns only 90%. So calculate 90% of net assets. 90 into 1,50,000 you do. How much is it? 1,35,000. So the worth of your investment is 135. But how much is the cost of investment in the first case? 140. The worth is 135, but the amount paid is 140. You paid 140, worth is only 135. So holding company made a loss. That loss only we call it as what? Goodwill. Understood? Maybe one more case I'll do. Okay. Second case. On the date of control, how much is net assets? 1,30,000. How much percentage share? Each are independent case, separate case. How much does holding company owns? 80%. Net asset is 1,30,000. 1,30,000 is for 100%. But holding company owns only 85%. So 1,30,000 into 85% you do? 1,10,500. So the worth of your investment is 1,10,500. How much did holding company pay? What is the cost of investment in second case? 1,04,000. For 1,10,500, they paid only 1,04,000. So holding company has paid more or less? Less. That means for holding company, it's a loss or profit scenario. Profit scenario. That profit only we call it as capital reserve. Like this, can you complete for the other one? Okay. Last step is calculate the amount of holding company's profit to be shown in consolidated balance sheet. Sir, if you remember working note number 7, you take holding company ka profit. To that you add what? Post acquisition profit of subsidiary. That they are asking. How much is post acquisition profit of subsidiary? Post acquisition profit means what? How much profit came after holding company became shareholder? So check here the first case, or maybe I'll take first case. I'll take what was the P&L balance on the date of control? 50,000. At the end of the year, it has become 70. Sir, 50 has become 70. That means what? 20,000 is pre or post acquisition profit. Correct? Holding company will get entire post acquisition profit or only their share? Their share. How much is their share in first case? 90,000. That means how much will you get? 18,000. Okay, now that's how they calculate it. One more can we do? Yeah, this one. Maybe check this. Sir, what is the P&L balance on the date of control? 30,000. It has become 20,000. Oh, yo. P&L balance on the date of control was 30. At the end of the year, it has become 20. Means profit or loss. So in this problem, is it post-acquisition profit or post-acquisition loss? There is a post-acquisition loss. How much? 10,000. Parent will get entire loss or their share? Their share. How much is their share? 85%. So into 85% you do 8,500. Sir, post-acquisition profit means you will add. Post-acquisition loss means subtract. So 8,500, you should plus or minus or minus. That's all. This question also could be important. Fine, sir. So I feel they'll play around these sort of questions. Okay. So with this consolidation standard, we fully completed. Thank you.